Hello friends, today's topic is illustrations. In this topic, we'll be solving various problems which will help us to clearly understand the provisions of the profit and gains from business or profession. Hello friends, starting with the first illustration. Mr. A, engaged in the manufacturing business, furnishes the following particulars relating to its manufacturing unit at Delhi for the year ended 31st March 2020. Opening WDV of plant and machinery is 20 lakhs. New machinery purchased on 1st of September 2019, which is more than 180 days. New machinery purchased on 1st December 2019, less than 180 days. Computer purchased on 3rd of Jan 2020, less than 180 days. Additional info: all assets are purchased by account pay check. All assets are put to use immediately. Accordingly, if assets are put to use immediately, then machinery purchased on 1st September will be used for more than 180 days, and accordingly the depreciation will be 100%. The amount will be 100%, and depreciation rate, if it is 15%, then it will be allowed as 15%. New machinery purchased on 1st December, the rate will be 50%. 15% divided by 2, 7.5%. Similarly, for computer purchased, it will be divided by 2. The rate will be divided by 2. New machinery purchased on 1st December 2019, and computer have been installed in the office. So they have been installed in the office. During the year ended 31st March 2019, a new machinery had been purchased on 31st of October 2019 for 10 lakhs. Additional depreciation. So additional depreciation besides normal depreciation had been claimed thereon. So effectively what we are trying to say over here is, previous year there was an asset which was less than 180 days, and accordingly the additional depreciation would have been claimed divided by 2. So half of the additional depreciation was claimed in the financial year 18-19, and now we will have to claim half of the another part of the additional depreciation as in the financial year 19-20. The depreciation rate is 15%, and the additional depreciation rate would be 20%. Compute the depreciation available to the SSC. So the expectation is depreciation available to the SSC is to be computed, and the WDV of different block of assets on 31st of March 2020. Different block of assets. There are two assets over here, machinery and computer. So different block of assets we need to compute WDV. Further, the section of additional depreciation has been mentioned over here for reading, so that this on this part we will be coming to after. Once we in the process of solving the problem, we will be studying, we'll be reading these provisions. So additionally, what I have tried over here is, I have laid down over here the illustrations. Further, the barrack of this section has been mentioned additionally. This won't be provided to you in the examination. However, while solving the problem, this will be useful for you to understand, to interpret the provision, and this is how you will be remembering it in the examination. Again, I am repeating, you will not get the barrack of the section in the examination. You will only get the problem, and you have to prepare a solution, you have to compute things. This section has been mentioned over here so that you can interpret the provisions more clearly. So this is only for your reference and it won't be provided in the examination. So to compute things, we have to compute depreciation and we have to compute WDV. Now let's start solving the problem. First is, let's take the WDV, computation of WDV. It will be as on March 31, 2020. First will be the two block of assets. First, let's compute it for plant and machinery. Opening WDV has been provided, which is nothing but 20 lakhs. So there are two machinery being added over here. New machinery, September 1, which is 10 lakhs, and new machinery, December 1, which is 8 lakhs. So in this case, in the block of assets concept, there would be additionally total, or we can say closing WDV. There are no further deletions or additions. So closing WDV of plant and machinery is nothing but 20 plus 10 plus 8, which is 38 lakhs. Second machinery is computer. For computer, opening WDV is not there, and addition is for 4 lakhs. There is no sale or something like that. So closing WDV we have it for computer as 4 lakhs. So the working of WDV will be for plant and machinery, closing WDV as on 31st of March is 38 lakhs, and for computer the closing WDV is 4 lakhs. Now let's consider computation of depreciation. First is, on opening WDV, asset value is 20 lakhs. The rate applicable is 15% and it will be 100% and not divide by 2 since it is more than 180 days. So I did not mention anything over here. So 20 lakhs into 15% is 3 lakhs. Then comes various assets. So the new asset, I should unbold it, asset purchased on September 1, which will be 10 lakhs into 15%, which is nothing but 1.5 lakhs. This is normal depreciation for asset purchased on September 1. Again, the additional depreciation will have to be calculated, which will be 10 lakhs into additional depreciation rate is 20%, and it is since the asset is used for more than 180 days. In this case, 2 lakhs entirely will be allowed as additional depreciation. So first is opening WDV, second is asset purchased on September 1, on which normal depreciation and additional depreciation has been calculated. The third is asset purchased on December 1, 8 lakhs into, in case of normal depreciation, it should be 50% because used for less than 180 days. 8 into 15% and divided by 2. So it is 0.6 lakhs. And for asset purchased on December 1, 8 lakhs into 20%. This is for additional depreciation. However, based on the facts, this additional machinery purchased on 1st December 2019 and computer have been installed in office. So I will go to section 32 in this regard. 32(1)(2)(a), what it says, whether the same will be allowed or not. The provision says, we'll be reading this, but before that, what the provision says is, you are eligible for the additional depreciation only if the new asset is purchased and it should be used for the purpose of manufacturing. So if it is installed in the office, it is not used for the purpose of manufacturing, and accordingly the additional depreciation won't be available. So 32(1)(2)(a), which is related to additional depreciation, in the case of new machinery or plant other than ships and aircraft which have been acquired and installed after 31st March 2005 by an SSC engaged in the business of manufacture or production of any article or thing, or in the business of generation, transmission or distribution of power, a further sum equal to 20% of the actual cost of such machinery or plant shall be allowed as deduction under clause 2. So 20% will be allowed for the person who is in the business of manufacture or production of any article or thing. So in our case, the person is in the manufacturing business. Mr. A is into manufacturing business, and accordingly we have calculated additional depreciation as well, and provisos provided further that no deduction shall be allowed in respect of any machinery or plant which before its installation by the SSC was used either within or outside India by any other person, not applicable. B. Any machinery or plant installed in any office premises or residential accommodation, including accommodation in the nature of guest house. So this sentence is important, wherein no deduction shall be allowed in cases where the machinery or plant is installed in any office or premises. Point C is any office appliances or road transport vehicles, and point C is the whole of the actual cost is allowed as deduction in computing. That is fine. So what we can say is, as per proviso 2, Section 31 to Section 32(1)(2)(a). As per proviso of Section 32(1)(2)(a, if the machinery is installed in any office premises, then additional depreciation is not allowed. So this is supposed to be mentioned in the note section, and this is how you will have to interpret the provisions, and this is how you will quote the section in the notes. So how will you quote is, as per proviso of section 32(1)(2)(a), if a machinery is installed in the office premises, then additional depreciation is not allowed. So continuing with keeping this in mind, here additional depreciation won't be calculated, and instead a note shall be inserted over here. Fine. And the fourth point, normal depreciation, we have already covered, and that is 50%. Now the computer depreciation on computer will be, the rate is 40%, 4 lakhs into 40%, and it should be divided by 2 because it is less than 180 days. So 40,000, 1 lakh 60, I feel 80,000 is the answer, into 40% and divide by 2, so it is 20%. 4 lakhs into 40%. 4 lakhs into 40% is nothing but 1.6 divided by 2, so it is 80,000. And again, on this asset, the additional depreciation won't be available only because it has been installed in the office premises. Fifth point, there was an asset which was purchased earlier. So continuing the fifth point will be the asset which was purchased last year. Existing asset, on the same, the normal depreciation would have been covered in the opening WDV. However, if you remember, the additional depreciation over here for this asset which was purchased last year is to be calculated. Half of the portion of the additional depreciation was remaining. So 10 lakhs is the amount purchased in financial year 18-19 for that asset. 10 lakhs into 20% into 50% would be allowed this year because 50% was already allowed last year. So 2 lakhs, so 1 lakh is the amount. So total depreciation, you can say, for plant and machinery. Before that, there was certain provision which we haven't covered. So 32(1)(2) as well, it will state us about the 180 days concept. So section 31(2), in the case of any block of assets, such percentage on the written down value thereof as may be prescribed, provided also that when an asset referred to in clause 2a, which is related to additional depreciation, or the first proviso to clause 2a, as the case may be, is acquired by the SSC during the previous year and is put to use for the purpose of business for a period less than 180 days in that previous year, and the deduction under this subsection in respect of such asset is restricted to 50% of the amount calculated at a percentage prescribed for an asset under clause 2A for that previous year, then the deduction of the balance 50%. Then the deduction of the balance 50% of the amount calculated at the percentage prescribed for such asset under clause 2A shall be allowed under this subsection in the immediately succeeding previous year in respect of that asset. So the balance 50% is supposed to be allowed in the immediately succeeding previous year. So that's what we have calculated over here, in which the remaining 50% depreciation we have calculated in the fifth point of our notes. So we are trying to calculate the total depreciation because it is to be calculated blockwise. Depreciation on plant is nothing but this was WTV. Then first is 3 lakhs, then 1.5, so total is 4.5, then 2 lakhs, 6.5, 6.5 plus 0.6 is 7.1. Computer won't be included in this block of asset, so 7.1 plus 1 lakh is 8.1. 8.1 lakhs is the depreciation allowable under section 32 plus 32(1)(2)(a) for assessment year 2021, and depreciation on computer is nothing but 0.8 lakh. So this concludes illustration 1, wherein majorly it was revolving around depreciation and additional depreciation. Moving on to the next illustration. Mr. X engaged in the business of generation and distribution of electricity. He always opts to claim depreciation on written down value for income tax purposes. From the following details, compute the depreciation allowable. Compute the depreciation allowable for the assessment year 2021. So, in the business of generation and distribution of electricity, and WTV method is opted for, and we are supposed to calculate the depreciation allowable in the hands of the SSC, in the hands of Mr. X. Opening WTV is 42 lakhs. New machinery was purchased 12 October 2090, less than 180 days. Machinery imported on 12th of April 2019. This machine had been used only outside India earlier, and the SSC is the first user in India. New computer installed in generation wing on July 2019. All assets were purchased by account pay check. So we have opening WTV, we have new machinery purchased for less than 182 days, one machinery which has been imported, and new computer installed in generation wing. So friends, let's start with the solution. In this part we can see again the depreciation part is to be calculated, and also first of all let's go asset by asset. So computation of depreciation allowable to Mr. X for assessment year 2021. then particulars and amount. Particulars will be, see, the way of presentation in this case, it could be either you calculate in the way of normal depreciation and additional depreciation, or either you calculate asset by asset. Ultimately, we need to compute the depreciation which is allowable to Mr. X. So there is no standard format as such. However, you could either adopt bifurcate in terms of normal depreciation and additional depreciation, or you can either present it asset by asset. In our case, in the previous example, we had mentioned based on asset by asset, the bifurcation was asset wise. Here also we will continue with asset wise bifurcation of additional and normal depreciation. Opening WDV, normal depreciation will be allowed, in which case 42 lakhs into 15% rate will be applicable, 6.3 lakhs. This is first part. Second is new machinery purchase, new, which was on 12th of October 2019. On this, first let's compute normal depreciation, which is 10 lakhs into 15%. It is less than 180 days accordingly. So 1.5 and into 50% is nothing but 0.75 lakhs. New 2019 additional depreciation. If you remember, for additional depreciation is allowed to a business which is into manufacturing business, and even to business which is into generation and distribution of electricity. So additional depreciation will be allowed to the new machinery as well, which is 10 lakhs into 20% and into 50%, because it is less than 180 days. The remaining 50% will be allowed in the next assessment year, in the immediately succeeding previous year. So 1 lakh. Third is machinery imported. So normal depreciation is nothing but 9 lakhs into 15%, 1.35 lakhs. Now the next question is for additional depreciation, whether it should be allowed or not. For this, while we were reading the extract of the section 32(1)(2)(a), in that there is a specific exclusion to the machinery imported, to the machinery which has been used in India or outside India. So if it's used machinery, maybe in India or outside India, if the machinery has been used previously, then the same is not eligible for additional depreciation. I will read out the provisions which we had discussed earlier. So this is section 32(1)(2)(a). In this, first of all, the highlighted portion, manufacture or production, which you can see over here, manufacture or production of any article or thing, or in the business of generation, transmission or distribution of power. So additional depreciation is available to a person who is into generation, transmission or distribution of power. At the rate of 20%, the same will be allowed. Then, provided further, no deduction shall be allowed in respect of any machinery or plant which before its installation by the SSC was used either within or outside India by any other person. So if it was used earlier, then the additional depreciation on the same won't be allowed as per proviso to section 32(1)(2)(a). So continuing with it, on machinery imported, not allowed. You will have to mention a note saying that as per proviso to section 32(1)(2)(a), any machinery which has been used earlier by any other person, then this additional depreciation on the same won't be allowed as deduction. Computer installed, normal depreciation should be 2 lakhs into 40%, and it was installed in July 2019, so it's 100%, 80,000, 80,000, so zero point 0.8 lakh. Then what about the additional depreciation of computer? It has been mentioned in the question that the same is used for install in generation wing. Since the same is installed in generation wing, it can be the depreciation on the same, additional depreciation on the same can be claimed. So 2 lakhs into 20%, and it will be 100% since it is used for more than 180 days. So over here 0.4 lakh is the answer. So depreciation allowable in this case is, so total depreciation is 6.3, normal depreciation on opening WDV 6.3 plus 0.75 plus 1 lakh plus 1.35 plus zero point 0.8 and zero point 0.4. So 10.6 lakh is the total depreciation which will be allowed as deduction to the SSC for assessment year 2021. In this illustration, we have discussed things on depreciation and additional depreciation, which business is related to generation and distribution of electricity. And in the first illustration, we had covered the person who is into business of manufacturing and what is the depreciation and additional depreciation allowed to the SSC. Now moving on to the next solution, to the next illustration. Illustration is examine with reasons the allowability of the following expenses incurred by Mr. A wholesale dealer in commodities, while computing profit and gains from business or profession. First is construction of school building. So the person is into, he is a wholesale dealer of commodities, and we will have to determine whether the following expenses are allowed or not along with reasons. So first is construction of a school building in compliance with CSR activities, which is corporate social responsibility activities, in which rupees 7 lakhs has been incurred by Mr. A. Now the business of Mr. A is wholesale dealing in commodities, and in first pointer he has expenses incurred for the purpose of construction of a school building which is in compliance of the CSR activities. So in a way it can be argued that these expenses are not related to the business. Now there are two sections involved over here. First is section 37(1), the residuary section, wherein the expenses which are specifically not mentioned from section 30 to 36 will get covered in section 37(1). Fine. So point 1 is the CSR activities are not specifically covered under section from section 30 to 36, and whether the same would be allowed under the residuary section of 37(1). Under section 37(1), priority requirement or the necessary requirement is that it should be incurred for the purpose of business or profession. In this case, the construction of school building, the construction of school building is not for the purpose of business. Accordingly, the same will not be allowed under section 37(1). So, the first pointer, construction expenses for construction of school building in compliance with CSR activities amounting to 7 lakh is not allowed as deduction in the hands of Mr. A, as the same is not related to the business of the SSC. Second pointer, purchase of building for the purpose of specified business of setting up and operating a warehousing facility for storage of food grains amounting to 7,25,000. So here expenses are incurred for specified business for setting up and operating a warehousing facility for storage of food grains. So in this case, the activities can be linked to section 3580, wherein 100% deduction will be allowed on the expenditure incurred if the same are incurred for setting up and operating a warehousing facility. So, in this regard, let's read 35 AD. Again, mentioning that this extract of the section won't be available in the examination, and it has been mentioned over here just for your reference, just to understand that how to interpret the provisions, and how you should be applying it in the examination. 35 AD, subsection 1, an SSC shall be allowed a deduction in respect of the whole of any expenditure of capital nature incurred wholly and exclusively for the purpose of any specified business carried on by him during the previous year in which such expenditure is incurred by him. Specified business means any one or more of the following, and in which one of them is setting up and operating a warehousing facility for storage of agricultural produce. So in this case, you can see that the deduction, the capital expenditure incurred by the SSC will be allowed 100% under section 35 AD. Based on these lines, the purchase of a building, which is a capital expenditure for the purpose of specified business, and the specified business is setting up and operating a warehousing facility for storage of food grains. Accordingly, this entirely will be allowed as deduction under section 35 AD. Point third, interest on loan paid to Mr. ABC. Interest on loan paid to Mr. ABC, who is a resident, of 70,000 on which tax has not been deducted. Sales of the SSC, sales of Mr. A during the preceding year was 3 crores. Mr. ABC has not paid the tax, if any, on such interest. So, Mr. A is paying interest on loan to Mr. ABC, and here the interest is paid to a resident. Any interest paid to a resident, an individual, or HUF, you can say the provisions of deduction of tax under section 194A will be applicable to individual or HUF if during the preceding year section 44AB is applicable to them. Section 44AB, which is provision related to tax audit, the same will be applicable to a business organization if the turnover in the immediately preceding year exceeds 1 crore. So, and if 44AB is applicable to an individual, he is liable to deduct taxes under section 194A, which is related to interest paid by a resident to a resident. So, in this case, I can see interest on loan is paid by Mr. A to Mr. ABC, who is a resident. In a way, there was a liability, there was an obligation of Mr. A to deduct taxes, which hasn't been deducted in this case. So, there are three sections involved over here. First is 44AB, which is regarding applicability of tax audit. Second is 194A, which is tax deduction, obligation of tax deduction of a resident individual where the payment is made to a resident person. So whether these expenses will be allowed or not is the question. The expenses of the question on deduction of the expenses will be answered in a negative way because no tax has been deducted, and the deduction which will be disallowed will be 30% as per section 40A IA. As per section 40A, 30% of the expense will be disallowed in the hands of the SSC. So this is the fourth section which is coming up. So this question sums up four sections, and you will have to apply this four section and in a way mention the same in the reason. You will read the extract of the sections, relevant sections in this case 194A related to TDS. Any person not being an individual or HUF family who is responsible for paying to a resident any income by way of interest other than income by way of interest on securities shall, at the time of credit of such income to the account of the payee or at the time of payment in cash or issue of a check or draft or by any other mode whichever is earlier, shall deduct income tax thereon at the rates in force, provided that an individual or HUF whose total sales, gross receipts or turnover from the business or profession carried on by him exceeds the monetary limits specified under Clause A or Clause B of 44AB during the financial year immediately preceding the financial year in which such interest is credited or paid shall be liable to deduct income tax. So, again, 194A initially had provided an exemption to individual or HUF. However, with the proviso, they have told that such individual or HUF whose total sales or gross receipts or turnover exceeds the monetary limit specified under section 44AB, which is 1 lakh, during the financial year immediately preceding the relevant financial year shall be liable to deduct income tax. So in our case, Mr. A had sales for the previous year as 3 crores, which is exceeding 1 crore, and accordingly he was liable to deduct taxes on the interest which he has paid. Fine. So as per section 194A, the person Mr. A was liable to deduct taxes. 44AB, every person carrying on the business shall, if his total sales turnover, gross receipts, as the case may be in business, exceeds 1 crore, exceeds 1 crore rupees in any previous year, then 44AB is applicable, and accordingly 194A is also applicable. 40IA, which is related to disallowance of expenditure incurred, 30% of any sum payable to a resident on which tax is deductible at source under Chapter 18B, which is nothing but TDS, and such tax has not been paid on or before the due date specified under subsection 1 of section 139. So the disallowance will be restricted to 30% of the expenses incurred where there has been no deduction of taxes, or after deduction the taxes haven't been paid to the government. So 40 IA 3613 is the deduction which will be allowed for the interest payment made by the SSC. The amount of interest paid in respect of capital borrowed for the purpose of business or profession will be allowed as reduction under section 3613. So in our case, the example will be that the person, Mr. A, was liable to deduct taxes under section 194A. So Mr. A, as per section 194A, read with section 44AB, was liable to deduct taxes on the interest on loan paid to a resident person. Accordingly, expenses incurred on the interest on loan amount, expenses incurred on interest by Mr. A will be disallowed to the extent of 30% as per section 40A IA. As per section 40 IA, 30% of the portion will be disallowed and 70% of the expenses incurred will be allowed in the hands of the SSC as per section 3613. So there were 4 sections in it, and how we utilize all these 4 sections, how we interpreted all these 4 sections in this relevant provision, this we have learned from this solution. So part 3 will be part disallowance and partly allowed part. Disallowed portion is 30%, allowed portion is 70%. Next is commodities transaction tax paid 15,000 on sale of bullion. So the person Mr. A is into wholesale dealer of commodities. Accordingly, in this regard, he has paid commodities transaction tax paid to the extent of 15,000. So whether the same will be allowed as deduction? The answer is yes. As per 36.1, as per provisions of 36.1, Mr. A will be allowed deduction of 15,000 because the same has been incurred for the purpose of business, and also the income related to these expenses will be offered to tax under the head profit and gains from business or profession. So in this regard, let's read 36.1.16, an amount equal to commodities transaction tax paid by the SSC in respect of the taxable commodities transaction entered into in the course of his business during the previous year, if the income arising from such taxable commodities transaction is included in the income computed under the head profit and gains of business or profession. So income of Mr. A is anyways taxed under the head. Income of Mr. A is anyways taxed under the head profit and gains from business or profession, and same being incurred, the expenses, the taxes paid being incurred in the course of the business of Mr. A, the same will be allowed as deduction under section 36(1)(16). So this is an allowable expenditure in the hands of Mr. A. So this concludes this illustration. Now friends, starting with next illustration, state whether true or false with reasons for the following statements. First is, for a dealer in shares and securities, STT paid in a recognized stock exchange is permissible business expenditure, whether the statement is true or false. The statement is true because as per section 36(1), a deduction is allowed to a person who is dealer in shares and securities, whose business is to deal in shares and securities, and that person is paying STT on a recognized stock exchange, then the same will be allowed as deduction to him, because the income from dealing in shares is offered under the head profit and gains from business or profession. Accordingly, expenses related to the business income will be allowed as deduction under section 36(1). Under section 36(1), there is a specific mention of allowance of STT while computing business income. And also, what I have done over here is I have mentioned the Bare Act, Bare section for your quick reference. Again, in the examination, you won't get any section reference over here. I have mentioned the reference over here only because that will be easy for you to interpret the provisions of the law. So with an example, you will be able to interpret the provisions of the law in a better way. So 36(1)(15) is the STT section wherein deduction of the securities transaction tax is allowed to a dealer of shares and securities, an amount equal to the STT paid by the SSC in respect of the taxable securities transactions entered into in the course of his business during the previous year. If the income arising from such taxable securities transactions is included in the income computed under the head profit and gains from business or profession. So if the same is included, if the income from dealing in shares is included under the head profit and gains from business or profession, then the STT paid on such transactions, the same will be allowed as deduction as per section 36(1)(15). Now the second part, where a person follows mercantile system of accounting, an expenditure of 30,000 has been allowed on accrual basis, and in the later year, in the subsequent year, in respect of the said expenditure, SSC makes the payment of 30,000 through cross check as end company. 30,000 can be the profits and gains of business under section 40A(3)(a) in the year of payment. So this is the question, whether 30,000 can be the profit and gains of business under section 40A(3)(a) in the year of payment, whether the statement is true or false. The answer would be 40A(3)(a) is nothing but where any cash payment is made in excess of 10,000 by mode of other than cash. So the SSC has been allowed the expenses on accrual basis in the relevant year, and in the subsequent year he has not satisfied the provisions of 40A(3)(a), wherein he has made the payment other than the mode which were not permitted. 40A3A, where an allowance has been made in the assessment for any year in respect of any liability incurred by the assessee for any expenditure. And so up till here, the allowance has been allowed to the assessee, and subsequently during any previous year, hereinafter referred to as subsequent year, the assessee makes payment in respect thereof otherwise than by an account payee check drawn on a bank or account payee bank draft or use of electronic system through a bank account or through such other electronic mode as prescribed. So if this mode of payment are not utilized, then expenditure will be disallowed under section 40A3A. The payments so made shall be deemed to be the profit and gains of business or profession and accordingly chargeable to income tax as income of the subsequent year if the payment or aggregate of payments made to a person in a day exceeds 10,000 rupees. So if the payment in the subsequent year is not through the specified modes of payment, in those cases, and the expenditure amount exceeds 10,000 in a day, if these two conditions are satisfied, then the entire payment won't be allowed as deduction in the subsequent year. This is what the provision of 40A3A says. And in our question, person was following mercantile system. Accordingly, 30,000 was allowed to him, and subsequently he made the payment through modes which weren't prescribed. Accordingly, 30,000 can be the profit and gains of business or profession under section 40A3A in the year of payment. So the answer is yes, it's true. The statement is true. 30,000 entirely will be profit and gains from business or profession and subject to tax in the year of payment. Third part, it is mandatory to provide for depreciation under section 32 of the Income Tax Act 1961 while computing income under the head profit and gains from business or profession. So the question is, it is mandatory to provide for depreciation under section 32 while computing profit and gains. The statement is true, and as per explanation 5 to subsection 1 to section 32, it specifically says that the depreciation is to be mandatorily calculated in the hands of the SSC. It will be always allowed to the SSC. SSC doesn't have any option that he doesn't want to claim depreciation for a particular year. As per the provisions of section 32, he has to claim the depreciation. I have mentioned the extract of section 32 of explanation 5. So subsection 1, explanation 5 to subsection 1 to section 32. For the removal of doubts, it is hereby declared that the provisions of this subsection shall apply whether or not the SSC has claimed the deduction in respect of depreciation in computing his total income. So as per explanation 5 to section 32(1), SSC has to claim the depreciation. It is mandatory to claim the depreciation. Next part, the mediclaim premium paid to GIC by Mr. X for his employees by a draft on 27th of October 2019 is a deductible expenditure under section 36. The statement is true that any mediclaim premium, the premium paid by the employer on behalf of the employee to a prescribed authority, to an approved authority, will be allowed as deduction if the mode the mode of payment should not be of cash, it should be other than cash. Other than cash, any mode of payment will be allowed as deduction to the SSC, to the employer. So the statement is true. Reading the extract, the deduction is allowed under section 36 IB 1B 36 1B, the amount of any premium paid by any mode of payment other than cash, any mode of payment other than cash by the SSC as an employer to effect or to keep in force an insurance on the health of his employees under a scheme framed in this behalf by the General Insurance Corporation of India, which is GIC, formed under Section 9 of General Insurance Business and approved by central government. In our case, the payment has been made by the employer to GIC or any other insurer and approved by IRDA, Insurance Regulatory and Development Authority, established under subsection 1 of section 3 of IRDA Authority Act. So it could be GIC, it could be any other insurer which is approved by IRDA, and the mode of payment should be other than cash. If these conditions are satisfied, then the deduction will be allowed under section 36 1B. So the fourth statement is also true. Fifth statement, under section 35 DDA, amortization of expenditure incurred under eligible VRS voluntary retirement scheme at the time of retirement alone can be done. Again, under section 35 DDA, amortization of expenditure incurred under eligible VRS at the time of retirement alone can be done. So meaning amortization of expenditure under VRS, can it be done in the year of retirement only, or it can be done in any previous year? This is the question. This is the statement. So the answer to this statement is false. The amortization of expenditure can be done in any of the previous year as per section 35 DDA, and the extract is subsection 1 of 35 DDA, where an SSC incurs any expenditure in any previous year by way of payment of any sum to an employee in connection with his voluntary retirement in accordance with any scheme or schemes of voluntary retirement. 1/5 of the amount so paid shall be deducted in computing the profit and gains of business for that previous year, and the balance shall be deducted in equal installments for each of the 4 immediately succeeding previous years. So the deduction, the amortization of expenditure on VRS will be allowed to the employer in the previous year, it could be any previous year, and it will be allowed in 5 equal annual installments starting from the year in which the payment is made. So it is not the retirement year, it is any previous year. So statement is false. Sixth statement, an existing SSC engaged in the trading business can claim additional depreciation under section 32(1)(2)(a) in respect of any plant acquired and installed in the trading concern by the increase in value of such plant as compared to the approved base price is more than 10%. So as per the question, a trading concern is eligible to claim additional depreciation on new plant and machinery if the increase in the value of such plant as compared to the approved base year is more than 10%. Because of this reason, the trading concern is eligible to claim additional depreciation whether this statement is true or false. The statement is false. Additional depreciation. The claim for additional depreciation cannot be made by a trading concern. The first condition for claiming an additional depreciation is it should be claimed by a manufacturing concern and the new plant or machinery purchased should be installed not in office premises apart from other conditions. So the first condition is additional depreciation is allowed only to manufacturing concern and it is not allowed to a trading concern. 32.1.2a. The relevant extract in the case of any new machinery or plant other than ships and aircraft which has been acquired and installed after 31st day of 2005, 31st day of March 2005 by an SSC engaged in the business of manufacture or production of any article or thing, or in the business of generation, transmission or distribution of power. A further sum equal to 20% of the actual cost of such machinery shall be allowed as deduction under clause 2. So the business should be a manufacturing business or business of generation, transmission or distribution of power. Additional depreciation is allowed only to this concern and not to a trading concern. Accordingly, the statement is false. Now friends, the next illustration. Examine the allowability of the following expenses, stating reasons therein. First, provision made on the basis of actuarial valuation for payment of gratuity of 3 lakhs. However, no payment on account of gratuity was made before the due date of filing return. So there is a provision of gratuity based on actuarial valuation and there is no actual payment. So whether such expenses, the only provision is made and there is no actual payment, whether such provision of gratuity will be allowed as deduction against the business income is the question. The answer is it is not allowed as per section 40A7 because the process of gratuity payment is, let me tell you the process of the actual provision and payment of gratuity that will help you to understand the practical scenario and how to interpret the provisions accordingly and why such provisions have been made. So whenever an employer has to make the payment of gratuity is generally payable once employee completes 5 years with the same employer and the employer starts making the provision from the first day itself, assuming that the employee will continue with the company for more than 5 years. And accordingly, from the first day itself, year on year, an actuarial valuation of the provision of gratuity amount is made. So there will be an actuarial valuer who will value the amount of gratuity payable by the employer and accordingly based on the valuation done the employer makes the provision in the books of accounts and thereafter the payment is supposed to be made, a provision for payment of gratuity fund. Thereafter the payment will be either made to a private gratuity fund, approved gratuity fund by the employer based on actuarial valuation, or either the payment is indeed due to the employee. For example, an employee who has completed 5 years with the employer and he is supposed to be terminated. His last day is, for example, May 2020. So, in the books of accounts, a provision will be required to be made on March 2020 wherein a payment of gratuity will be payable to the employee. So for that purpose also a provision is required to made on March 2020 by the employer. So if the provision is made for the purpose of payment to the gratuity fund, approved gratuity fund, or if the provision is made for the purpose of payment of gratuity to the employee, only in these two cases the employer will be allowed to claim deduction of the provision made. So in this case, a provision has been made on the basis of actuarial valuation and not for the purpose of approved gratuity fund or for the purpose of payment to the employee. That fact is missing. If this provision is for the actuarial valuation and thereafter there will be a payment to a gratuity fund, then these expenses will be allowed. So we will have to mention a note in the solution wherein the provision for payment to gratuity fund is allowed as deduction and provision for payment to employee is allowed as deduction to the employer, and it has been assumed that this provision for actuarial valuation is not for the purpose of payment to gratuity fund. That's the note that we will have to put. That's the note that we will have to mention in this solution. So answer to this statement is expenditure won't be allowed as deduction since provision has been made on the basis of actuarial valuation, and also there is no actual payment as well before filing of tax return. I mentioned the extract over here. 47A, subject to the provisions of clause B, no deduction shall be allowed in respect of any provision. 47, just a second. 47, this entirely is the 47. Clause A, subject to the provisions of clause B, no deduction shall be allowed in respect of any provision, whether called as such or by any other name, made by the SSC for the payment of gratuity to his employees on their retirement or on termination of the employment for any reason. So clause A says no deduction shall be allowed for any provision, and it is subject to clause B. Nothing in clause A shall apply in relation to any provision made by the SSC for the purpose of payment of a sum by way of any contribution towards an approved gratuity fund or provision for the purpose of payment of any gratuity that has become payable during the previous year. So provision is allowed only for these two parts, and any provision other than that won't be allowed as deduction. Explanation for the removal of doubts. It is hereby declared that where any provision made by the SSC for the payment of gratuity to his employees on their retirement or termination of their employment for any reason has been allowed as deduction in computing the income of the SSC for any assessment year, any sum paid out of such provision by way of contribution towards an approved gratuity fund or by way of gratuity to any employee shall not be allowed as deduction in computing the income of the SSC of the previous year in which the sum is so paid. This explanation says that there won't be a possibility of double deduction once a deduction is allowed based on provision to approved gratuity fund or payment to gratuity. Once a deduction is allowed on, you can say, accrual basis, the same won't be allowed when it is paid in the subsequent year. Next statement, purchase of agricultural produce of 70,000 in cash from a farmer on a banking day. So the payment is exceeding 10,000 and that too in cash. So ideally 40A3, there will be a disallowance where the payment is exceeding 10,000 in a day and the payment is made in cash. However, there are certain exceptions where the payment is made for the purchase of an agricultural produce and the payment is made directly to cultivator to producer. In those cases, there will be no such thing, as in there will be no limit of 10,000 and there will be no restriction on the mode of payment. Even if the payment has been made in cash and it is exceeding 10,000, the payment will be allowed as deduction in the hands of the payer. Relevant extract of 48.3. The SSC incurs any expenditure in respect of which a payment or aggregate of payments made to a person in a day, otherwise than by an account payee check drawn on a bank or account payee bank draft or use of electronic clearing system through a bank account or through any other mode exceeds 10,000, no reduction shall be allowed in respect of such expenditure, provided no disallowance shall be made and no payment shall be deemed to be profit and gains under subsection 3, and this subsection where a payment or aggregate of payments made to a person in a day otherwise than by a so and so mode of payment exceeds 10,000 rupees. In such cases and under such circumstances as may be prescribed, having regard to the nature and extent of banking facilities available, considerations of business expediency and other relevant factors. So 48.3 general provision says exceeds 10,000, then there will be a disallowance. However, there is a proviso which says no disallowance shall be made if certain conditions are satisfied and the same is prescribed. The same is prescribed. Accordingly, we will have to refer to rule. Relevant rule of 48.3 is rule 6DD, which is mentioned in the next slide. So what is prescribed? Rule 6DD. No disallowance under subsection 3 of 40A shall be made and no payment shall be deemed to be profit and gains under subsection 3A of section 40A, where a payment or aggregate of payments made to a person in a day otherwise than by way of so and so modes exceeds 10,000. So clause E, the relevant clause, the extract of it, that the payment is made for the purchase of agriculture or forest produce to the cultivator, grower or producer of such articles, produce or products. So as per section, as per proviso to section 40A3, read with rule 6DD, any payment to the cultivator, grower or producer of the agricultural produce, if payment has been done to such person, then the payer will be allowed the deduction of the expenditure even if there is a cash payment, even if the amount is exceeding 10,000 in a day. So this is how you will have to interpret the provisions. This is how you will have to apply the provisions based on the problem given, based on the statement given. Illustration part 3. Tax on non-monetary perquisite provided to an employee 35,000. Whether the same will be allowed or not in the hands of the employer? The question is no. Tax on non-monetary perquisite is specifically disallowed in the hands of the employer under section 40A5 because, as a process, I will explain you the process first, wherein a non-monetary perquisite is provided by the employer to the employee, and tax thereon is also borne by the employer. Tax thereon is also paid by the employer on behalf of the employee. In such a scenario, the tax paid should be a benefit in the hands of the employee. However, tax on such benefit will be exempt in the hands of the employee. Ideally, it should have been taxed in the hands of the employee. However, the same is exempt in the hands of the employee under section 1010cc. Accordingly, since that amount, tax on monetary perquisite paid by the employer, that amount is exempt in the hands of the employee, it is supposed to be taxed in the hands of the employer. Accordingly, deduction of such payment, deduction of tax on non-monetary perquisite is not allowed in the hands of the employer, and there is a specific exclusion under section 40A(5). Section 40, Section 40, notwithstanding anything to the contrary in sections 30 to 38, the following amounts shall not be deducted in computing the income chargeable under the head profit and gains. In case of any SSC, one of the provision is any tax actually paid by an employer referred to in clause 10cc of section 10(10)(cc). So accordingly, any tax actually paid by the employer won't be allowed as deduction, shall not be deducted. 10(10)(cc) says, in the case of an employee being an individual deriving income in the nature of perquisite not provided for by way of monetary payment, that means non-monetary payment, within the meaning of clause 2 of section 17, non-monetary perquisite, meaning the tax on such income actually paid by his employer at the option of the employer on behalf of such employee, notwithstanding anything contained in section 200 of Companies Act. So here you can see section 10 refers to the exemption part, and any amount mentioned, any provision mentioned under section 10 is exempt. So this is the provision wherein tax is paid by the employer. Such should have been a benefit in the hands of the employee. However, an employee is specifically exempt as per section 10(10)(cc), and accordingly that expenditure won't be allowed as deduction to the employer, because if allowed, then that will amount to double deduction or double benefit, one to employee and also to employer. So since the benefit is provided to employee in the form of exemption under section 10, again a benefit to the employer won't be allowed under profit and gains provisions. Accordingly, a specific non-deduction provision is mentioned under section 40. Moving on to the next part, salary payment of 4 lakhs to Mr. X outside India by a company without deduction of tax, assuming Mr. X has not paid tax on such salary income. So there is a salary payment of 4 lakhs to a person, to a non-resident, by the employer, and no tax has been deducted, wherein the income is exceeding, assuming that Mr. X doesn't have any income in India apart from salary income, then also the income is exceeding the basic exemption limit. Accordingly, taxes are payable by the employee, by Mr. X. However, the employer hasn't deducted any taxes under section 192. Accordingly, since taxes are not deducted, the same will be disallowed. The expenditure, the salary payment will be disallowed under section 40A. And for this sentence, assuming Mr. X has not paid tax on such salary income, there are provisions wherein if the employee pays the taxes through self-assessment tax, if employee pays the relevant taxes due through self-assessment tax, then the employer won't be treated as SSC in default, and accordingly there is a possibility that deduction of salary payment may be allowed to the employer. However, there is a sentence mentioned over here wherein Mr. X has not paid any tax on the salary income. Accordingly, that possibility also is not there, wherein taxes are paid by the employee and deduction may have been allowed to the employer. So, answer to the fourth statement is expenditure won't be allowed to the employer since no taxes have been deducted by the employer while making the salary payment. Section 40. Notwithstanding anything to the contrary in section 30 to 38, the following amounts. Section 40. Notwithstanding anything to the contrary in section 30 to 38, the following amounts shall not be deducted in computing the income chargeable under the head Profit and Gains. In the case of any SSC, Part 3, any payment which is chargeable under the head Salaries, if it is payable outside India or to a non-resident, and if the tax has not been paid thereon, not deducted therefrom under Chapter 17B, which is TDS chapter. So, taxes are, if not deducted, then the same will be disallowed under 40A3. Next is, and the last one is, payment made in cash of 25,000 to a transporter in a day for carriage of goods. So as per 40A3, where a payment is made for the services of flying, hiring, and leasing of goods carriages, there is a standard limit of 10,000 won't be applicable. The limit is extended to 35,000 for the transporter. So where a payment in a day is made to a transporter which is into flying, hiring, and leasing of goods carriages, the limit applicable is 35,000. So this payment will be allowed as an expenditure in the hands of the employer, in the hands of the payer. 40A3. As the SSC incurs any expenditure in respect of which a payment or aggregate of payments made to a person in a day, otherwise than by way of so and so modes, exceeds 10,000, no deduction shall be allowed. Provided further, there is a proviso that in the case of payment made for flying, hiring, or leasing goods carriages, the provisions of subsection 3 and 3A shall have effect as if for the words 10,000, the words 35,000 rupees has been substituted. So instead of 10,000, 35,000 will be made applicable, and in our case, since the payment is less than 35,000, which is 25,000, the payment will be allowed. Now friends, the next illustration, trading and profit and loss account for year ended 31st March 2020 of Mr. X is as follows. Opening stock, purchases, gross profit, sales and closing stock, salary, rent, interest on loan, depreciation, printing and stationery, gross profit, and income from UTI. Expenses continued, postage and telegram, loss on sale of shares, short term, other general expenses 8,000, and net profit. Additional information, it was found that some stocks were omitted to be included in both opening and closing stock. So the values appearing in trading account above will have to be edited, wherein the values are which has been omitted. Opening stock is 12,000 and closing stock is 20,000. The depreciation provided in the profit and loss account is 1,05,000, which is based on following information. WDV of plant and machinery is 4,20,000 as on 1st of April 19, which is the opening WDV. A new plant falling under the same block of depreciation was brought on 1st of July 2019. Number of days exceeds 180 days. Two old plants were sold on 1st of October 2019. So this value will be deducted from the entire block of assets. So there is opening WDV, there is addition of an asset, and certain assets have been sold. Thereafter depreciation will have to be calculated. So virtually, this provision, this paragraph, we will have to recompute depreciation and just see whether the depreciation is as per income tax law or not, because the depreciation which has been mentioned under the profit and loss account will be as per Companies Act or other provision. Rent rates includes GST liability of 5,000 paid on 7th of June 2020. So the same is paid on 7th of June 2020. Salary includes 10,000 paid to his brother, which is unreasonable to the extent of 5,000. Unreasonable, any payment to the relative to the extent unreasonable will be disallowed. The whole amount of printing and stationery was paid in cash. So printing and stationery is paid in cash by way of one-time payment. You will have to see whether it exceeds 10,000. Yes. So this will also be disallowed. Other general expenses includes 4,000 paid as donation. So general expenses includes donation to public charitable trust. What is the requirement? You are required to compute the profit and gains of Mr. X under presumptive taxation under section 44 AD and profit and gains as per normal provisions of the Act. So there are two requirements. First, presumptive provision as per section 44 AD, and second is computing profit and gains as per normal provisions. Assume that the whole of the amount of turnover received by account pay check or use of electronic clearing system to bank account during the previous year. So this will be useful for section 44 AD. So friends, let's start with the solution. We'll keep the note section over here, in which computation of business income of Mr. X for the assessment year 2021. First is particulars and then amount. First will be, you will have to mention the net profit as per the profit and loss account, which is 311,960. Then add inadmissible deductions, income chargeable, you mean to say. For this header, first point is, first adjustment is omission of stock. So closing stock will have to be added of 20,000 to the income. Undervaluation of closing stock, which is nothing but 20,000. Second adjustment, depreciation is fine. Rent rates includes GST liability of 5,000. However, depreciation to be considered separately. So this will not be allowed for now. Then rent and rates includes GST liability of 5,000. Same is paid on 7th of June 2020. Since the same is paid before due date of filing of return of income, the same will be allowed. Accordingly, no adjustment for it. The rent rates will be allowed entirely. Nothing will be disallowed. Third is salary paid to brother, salary to relative. As discussed earlier, this will be disallowed. 40A to the extent unreasonable, which is 5,000. Then printing and stationery, everything is paid in cash. Again, that will also be disallowed. Printing and stationery 40A3. The amount is 15,000, I guess, 15,000. Other general expenses includes the donation amount over here, which should be separately treated under section 80G. So it won't be included over here. Donation, which is 4,000. So this covers all the adjustment. Now less deduction which are actually allowed, deduction allowable or income exempt. This should be deducted. Again, first adjustment is opening stock, undervaluation of opening stock. So in a way, sort of expense side, it should be mentioned undervaluation of opening stock, which is 12,000. Second is depreciation. Depreciation we will have to claim it separately. Let's compute it. Opening WDV, it's nothing but 4,20,000. Add asset to the block of asset, which is 70,000. New asset is 70,000 less sale of asset, which is nothing but 50,000. So through this, the closing WDV is 4,20,000 plus 70,000 minus 50,000, 4,40,000 less rate of depreciation applicable to plant and machinery is 15%. Accordingly, into 15%, 66,000. This will be the normal depreciation. Also, the 182 days concept won't apply because the asset has been purchased on 1st of July 2019. So rate of depreciation of which is normal depreciation will be 100%. Accordingly, 66,000 is the rate of reduction, and additional depreciation we will have to analyze whether the same is applicable or not. So a new plant and machinery is purchased. This is fine. And whether the SSC is into manufacturing business or not, we will have to see. As you can see, the person is into trading business. Accordingly, additional depreciation won't be available to the SSC. So additional depreciation is not applicable. So we can see the rate of depreciation is 66,000. Accordingly, second pointer was depreciation which has been allowed as 66,000, and third is I feel all the additional notes out of all the additional notes adjustment has been made. There was something in the trading and profit and loss account, this income by way income received from UTI, which is supposed to be exempt under section 1035. So 5,000 will be the income exempt and accordingly not subject to tax. So income which is exempt is to be mentioned over here. Income from UTI exempt under section 1035. Amount is 5,000. So business income will be income from business or profession as per normal provision. As per normal provision is, we will have to add it up, 311,960, addition of 20, 1,05,000, so 1,25,000, 1,30,000, 1,45,000 plus 4,000, that is 1,49,000. So till here, addition of 1,49,000 which is to be added, which is total of inadmissible deduction or income which is chargeable separately, income which is chargeable under the profit and gains. So 460, 960, and deduction admissible are 12,000 plus 66,000, which is 78,000, and 5,000. So 83,000 minus, sorry, my mistake, 460, 960 minus 83,000, which is admissible expenses or income exempt, 377,960 is the income from business or profession, 377,960. So this is the business income as per normal provision. Now section 44AD, the presumptive taxation. As per this provision, what is the business income? So we will have to see the turnover. Turnover is 1,411,500, which is 1,14,11,500. Yes, and the rate of tax applicable for presumptive is generally 8%. However, if the transaction is in electronic mode, then the percent is 6%. So into 6%, 684, 690 is the business income. 684, 690 is the business income as per section 44AD, and the rate of tax applicable is 6%. So friends, this conclude this illustration wherein we have studied how to compute business income under normal provision and how to compute business income under presumptive taxation under section 44AD. Now friends, continuing with the next illustration. On your screen, compute the total income of Mr. Innovative for the assessment year 2021. Taking note of the following data, Mr. Innovative is engaged in the business of plying goods carriages. So the relevant section that will be applicable will be section 44 AE. On 1st of April 2019, he owns 8 trucks. The SSC owns 8 trucks, out of which 5 are heavy goods vehicles, and the gross vehicle weight of the goods vehicle is 10,000 kg each. On 1st of May 2019, he sold one of the heavy goods vehicle and purchased a light goods vehicle on 6th May 2019. This new vehicle could however be put to use only on 15th of June 2019. So one asset of heavy goods vehicle was sold and one asset of light goods vehicle is purchased by the SSC. Particulars. So as per para of April 1, 2019 over here, as per this para, we can conclude that section 44 AE is indeed applicable to the SSC, as the number of trucks owned by the person is less than 10, and accordingly section 44 AE will be applicable. In section 44 AE there are two bifurcation on which taxability is determined. First is bifurcation into heavy goods vehicle and light motor vehicles. Light goods vehicle, in heavy goods vehicle the taxability is determined by per ton, 1,000 rupees per ton per month or part of the month, and for light goods vehicle the taxability is 7,000 per month or part of the month. INR rupees 7,000 per month or part of the month. So particulars, freight charges collected. Freight charges collected is 11,90,000 less operational expenses, less depreciation, less other office expenses. The net profit is coming out as 6 lakhs, and other business and non-business income is 95,000. So we are supposed to compute the total income of Mr. Innovative for the assessment year 2021, which is in the business of plying goods carriages. And as we have discussed that section 44A will be applicable and the bifurcation will be as per heavy goods vehicle and light goods vehicle, wherein the SSC has sold as well as purchased certain goods vehicle during the previous year. So as part of this solution, let's compute deduction available or the taxability of income as per section 44 AE, and also we will analyze whether the taxability as per the normal provisions should be applicable to the SSC or not. I mean whether the SSC should be opting for the normal provisions or presumptive taxation as per section 44 AE. And before that, let's quickly read the provisions of section 44A for quick recap. Section 44A subsection 1, notwithstanding anything to the contrary contained in section 28 to 43C, in the case of an SSC who owns not more than 10 goods carriages at any time during the previous year and who is engaged in the business of plying, hiring and leasing such goods, the income of such business chargeable to tax under the head profit and gains of business or profession shall be deemed to be aggregate of profit and gains from all the goods carriages owned by him, computed in accordance with subsection 2. So taxability will be determined as per subsection 2, and the person should be in the business of plying, hiring and leasing of goods carriages. For the purpose of subsection 2, subsection 1, the profit and gains for each goods carriages being a heavy goods vehicle. In case of heavy goods vehicle, an amount equal to 1000 per ton of gross vehicle weight will be considered for every month or part of the month during which the heavy goods vehicle is owned till the period till which the asset is owned by the SSC, or an amount claimed to have been actually earned from such vehicle whichever is higher. Other than heavy goods vehicle, that is light goods vehicle, amount equal to 7500 rupees for every month or part of the month during which the carriage goods is owned by the SSC, or an amount claimed to be of have been actually earned from such goods carriages whichever is higher. And subsection 7, where an option of applicability of normal provisions is applicable to the SSC. Subsection 7, notwithstanding anything contained in the foregoing provisions of this section, an SSC can claim lower profits and gains than the profit and gains specified in subsection 1 and 2. An SSC may claim a lower profit if he keeps books of accounts and gets his accounts audited. So if the SSC is claiming that he has a lower profit as compared to the presumptive taxation, if the SSC is claiming that his books of accounts maintain, as per the books of account maintain, he has lower profits, then the person will be required to get his accounts audited as well. Now quickly starting the computation after reading the provisions, and mind you, these provisions won't be given in the examination. Here the provisions are stated only for the purpose of how to interpret the provisions while solving problems. Computation of tax under section 44 AE. First is heavy goods vehicle. So there are two vehicles over here and there are 5 heavy vehicles mentioned over here. Total are 5 and one of them is sold. So sold vehicle taxability will be determined based on the period for which the asset is owned, and the asset was sold on 1st May. So for 2 months it will be calculated. Even the May month will be calculated because it includes part of the month. So part of the month will be considered as full month, and accordingly for 2 months the presumptive income will be calculated. So 2 months the taxability, and since it's a heavy goods vehicle, 1000 per ton, and the goods vehicle capacity is 1000 kg divided by 1000 is per ton. So 10 ton is the capacity of each and every vehicle. Here we have only 2 vehicles. Here we have only 5 vehicles heavy goods and 1 vehicle is sold out of them. So 1 vehicle into 1000 per ton. Per ton is nothing but 10,000 kg has been mentioned over here, divided by 1000 to convert it into per ton, and 1000 per ton is as per the provisions. So the solution will be 2 months into 1 vehicle, 1000 ton. So effectively it is 2 into 1000 into 10, which is nothing but 20,000. Okay, so remaining for heavy goods vehicle, which is nothing but which will be considered for 12 months into 4 vehicles into 1000 per ton as per the provisions of 44 AE into 1000 kg divided by 1000 to convert it into per ton, which is nothing but 12 into 4 into 1000 into 10. So let's use the calci for it. So the solution will be 12 into 4 into 10,000, which is nothing but 4,80,000. So this was for heavy goods vehicle, wherein there was a bifurcation for assets sold and the asset which SSC continued to hold. Now light goods vehicle, in this case asset is purchased and there are 3 light goods vehicle, which is 8 minus 5. So purchased on 6th of May, so effectively 11 months. So the date on which the asset is used doesn't matter. The date when it is purchased will matter as per section 44 AE. So 11 months into one vehicle into 7,500 per month, and remaining asset is nothing but 3, which has been used for 12 months into 3 vehicles into 7,500. So 7,500 into 11, 82,500, and 7,500 into 12 into 3, 2,70,000. Accordingly, taxation under section 44 AE is nothing but 20,000 plus 4,80,000, which is 5 lakhs, and 5 lakhs plus 82,500 of light goods vehicle plus 2,70,000. So 8,52,500 is the taxable income under presumptive taxation under section 44 AE, this can be compared with the normal provisions, which should be net profit as 6 lakhs. So here you can see 6 lakh is the net profit accordingly, and the other income is 95,000 fine. So normal provisions, if you see taxation under section 44 AE, so under presumptive, total income under presumptive taxation is nothing but 8,52,500 plus 95,000, which is the other income. Total is 947,500, and taxation as per normal provisions. The books of account are maintained, and also the SSC may have to get the books of account audited if he claims that profit are less than the presumptive taxation. It is 6 lakhs plus 95,000, so it is 6,95,000. Accordingly, the taxation, the income, you can say the income as per normal provision, the income as per normal provision is less than the income under presumptive taxation, and accordingly there is an option available to the SEC where he can claim that my income as per my books of accounts are less, wherein the additional condition that the SEC is required to satisfy is he will be required to get his books of accounts audited as well. So the total income of Mr. Innovative for assessment year 2021 as per presumptive taxation is 9,47,500, and as per normal provisions is 6,95,000. Now friends, continuing with the next illustration. Mr. Manufacturer and Trader, a manufacturer at Chennai, gives the following manufacturing, trading and profit and loss account for the year ended March 2020. So he is the manufacturer. Opening stock, purchase of raw materials, manufacturing wages, gross profit, sales, closing stock, administrative charges, GST, state GST penalty. Over here, generally, if penalty is on account of delay in payment, it can be termed as compensatory in nature and it may be allowed. However, if a penalty is related to contravention of the provisions of the law, then penalty will never be allowed to the SSC. So we will have to put a note assuming that either it is whether it is a compensatory penalty or penalty on account of contravention of the law. If it is on account of contravention of the law, then penalty deduction won't be allowed to the SSC. GST paid, gross profit, exempt dividend which shouldn't be included, and income from agriculture which again won't be included. General expenses, interest to bank on machinery term loan. So over here interest is also taken from bank. Depreciation and net profit. Further information, bank term loan interest actually paid up to 31st of March 2020 was 20,000, and the balance was paid in 2020, October 2020. So meaning after the due date of filing of return, the interest was paid. Accordingly, as per section 43B, interest deduction won't be allowed whichever interest is paid after the due date of filing return. Administrative charges include 50,000 paid as commission to brother of the SSC. The commission amount at the market rate was 36,000, and in the administrative charges it has been included as 50,000, which is excessive, and as per 48.3 it will be disallowed to the extent of excessive portion. the SSC paid 31,000 in cash to a transport carrier on 21st of December 2019. So there is a payment in excess of 10,000 over here. So 40A3 implications needs to be seen. This amount is included in manufacturing expenses. Manufacturing expenses is over here. This has been included over here. Assume that the provisions related to TDS are not applicable to this payment. So TDS provisions are not applicable. However, a cash payment is done of more than 10,000. 40A3 implications will be there. However, there is an exception under section 40A3 wherein any payment to a transport carrier person, any payment to such person who is into transport facility, then the limit of 10,000 should be increased to 35,000. So since it is less than 35,000, deduction under section deduction for profit and gains will be allowed. A sum of 5,000 per month was paid as salary to a staff throughout the year, and this has not been recorded in the books of accounts. So here as well there will be two scenarios, as if the fourth question relates to the provision in the books of accounts for the purpose of salary, wherein there has been an arrear. It appears to be an error on the part of the accountant to not provide for the salary of the person. So if it is the case wherein only a provision was pending on the part in the books of accounts, in that regard, the same will be allowed. 5,000 per month will be allowed to the SSC as deduction. However, it could be a case of unexplained expenditure as well, wherein something which has not been recorded in the books of accounts and it has come to the notice of assessing officer. Accordingly, such unexplained expenditure can be treated as deemed income in the hands of the SSC, and accordingly tax will be imposed at 60% as per section 115 BBC. So it could be a case of unexplained expenditure also, or if it is in the case of provision of salary expense, then it will continue to be allowed. So we will have to put a note in this regard, wherein whichever way we are adopting, conservative way, I mean the aggressive way would be that it is an unexplained expenditure. By apparent reading of this adjustment, it's like it may be an error on the provision part of an accountant. Accordingly, in the books of accounts, once it is noticed, it has been recorded and provided for the arrears of salary payable. Accordingly, it will be allowed to the SSC at deduction, and in the note section we can always mention that even section 69C implications may be applicable for unexplained expenditure. Housing loan principal repaid during the year was 40,000, so eligible for ATC deduction, and it relates to house property, to residential property acquired by him in 1819 for self-occupation. Interest on housing loan was 13,000, and the amount were not dealt in the profit and loss given above. So property which is self-occupied, it will be treated under the income from house property, and a deduction of 13,000 of interest on housing loan will be available to the SSC as per section 24B, and the housing loan principal amount repaid will be allowed as deduction under section 80C of 40,000 while computing the total income, if any. If the question asks us to compute the total income, then its implications will be in income from house property. Depreciation allowable under the Act is to be computed on the following basis. Plant and machinery depreciation rate is 15%. Opening WDV is 1st of April is 9 lakhs. Additions during the year which has been used for more than 180 days is 2 lakhs. Total additions during the year is 3 lakhs. So effectively 1 lakh has been used for less than 180 days, accordingly the depreciation rate will be divided by 2. 15% divided by 2, 7.5% will be applicable on the additions which has been used for less than 180 days. Ignore additional depreciation. Additional depreciation is to be ignored. Since the SSC is into manufacturing division, there may have been implications for additional depreciation, but as per the question, we are not supposed to calculate any additional depreciation. Compute the total income of the SSC. Compute the total income of the SSC and ignore 14A implication. So let's start from here, wherein we have to compute over here the total income of the SSC, which will not only include profit and gains income, but also income from house property deduction under Chapter 6C, total income of Mr. Manufacturing and Trading. I am writing it in short form for assessment year 2021. First is income from profit and gains from business or profession. So here net profit during the year as per profit and loss account. Net profit during the year is nothing but 9,89,000. Then add expenses which are to be disallowed, or expenses disallowed and income not considered will be added over here. So first is, let's go adjustment wise. Bank term loan interest actually paid up to was 20,000 and the balance was paid in October 2020. So the total interest to bank on machinery term loan was 60,000, and out of this 20,000 was actually paid up to 31st March, and balance 40,000 is paid after the filing of return of income of the SSC. Accordingly, bank term loan disallowed as per section 40A, 43B, which will be 60,000 minus 20,000, which is nothing but 40,000. Second is administrative charges include 50,000 paid as commission to the brother, and 50,000 minus 36,000 will be not allowed as deduction in the hands of the SSC. So commission paid to relative or brother of the SSC, disallowed. Excessive portion is disallowed under section 40A3, which is to the extent of, it should be 48, which is to the extent of 14,000. 50,000 minus 36,000. Third part is SSC paid 31,000 in cash to transport carrier. Nothing will be disallowed, as we have discussed earlier, as the deduction allowed, I mean for transport carrier facility, the payment made, if it is up to 35,000 in a day, then nothing will be disallowed in the hands of the SSC. Then comes next adjustment, 5,000 per month salary. Again, this will continue to be allowed to the SSC. and we will have to put a note under section 69C. We will have to put an additional note wherein such salary income may have been taxable as unexplained expenditure under section 69C. But in our example, we have taken an assumption that the same has been provided in the books of accounts and accordingly will be allowed to the SSC. So, for first, third and fourth, let's put a note over here. Any expenditure other than, this is as per section 40A3, any expenditure other than the modes specified and above the limit of 10,000 is allowed where payment is made to transport operator. In that case, where total payment is not exceeding 35,000 in a day. So here nothing will be taxable as the payment made by the SSC to the transport operator is less than 35,000, which is 31,000 as per section 40A3. Any expenditure other than the mode specified therein, which is other than account paid check, which is other than account paid draft, ECS, or any other specified modes. So any other than mode specified therein and above the limit of 10,000 is allowed where the payment is made to transport operator. Transport operator is an exception to the general rule of section 40A3 and the payment should be made up to 35,000, then it is allowed. And the fourth point is related to provision of salary in the books of accounts will be allowed as deduction to the SSC. Separately, a view can be adopted wherein such salary expenditure can be taxed as unexplained unexplained expenditure under section 69C. Fine. So fifth point, which is housing loan principal repaid, which is related to income from house property and depreciation amount will be first added, which is provided as per the books of accounts. So you will have to add depreciation, which is 2 lakhs. And is there any other adjustment? No. So, and as per the profit and loss account, let's have a quickly go through it. If there is any adjustment, yes, a GST penalty, whether it can be disallowed. So for that an assumption needs to be put wherein if it is related to contravention of the provisions of the law, it won't be allowed as deduction. For SGST penalty, where there is delay on the part of the SSC, in payment of GST, then penalty may be allowed. However, if there is any contravention of the law because of which a penalty is payable, then nothing will be allowed. We are assuming that there has been penalty on account of, so 6 point will be on account of contravention of law as GST penalty, which is 5,000, 5,000, assuming penalty is on account of contravention of provisions of law. And anything to be added is add income which is exempt, income exempt, or expenses not considered. So it will include depreciation as well. First is dividend income, exempt under section 1034, 10,000, and agricultural income, which is exempt, which is 1,50,000. It should be less. And third point is for depreciation. For depreciation, we'll have to calculate the opening WDV is 9 lakhs, addition is 2 lakhs and 1 lakh. And there is no other adjustment which is affecting the depreciation value, right? Additional depreciation is already stated as being to be ignored for this solution purpose. So again, nothing will affect the depreciation, the value of the fixed cost. Accordingly, opening WDV is nothing but 9 lakhs. Additions, addition is 3 lakhs total, and for 2 lakhs it is more than 180. So it is 2 lakhs. So total is 11 lakhs, on which depreciation at 15% will be applicable, which is nothing but into 15%, 1,65,000. 11 lakhs into 15% is 1,55,000, 1,65,000. So this is first part. And additions less than 180, it is nothing but 1 lakh, and depreciation at the rate of 7.5%, which is nothing but 15% divided by 2, it will be 7,500. So total depreciation that will be allowed is 1,65,000 plus 7,500. It is nothing but, so this will be deducted. So we are required to compute total income of the SSC, as well as there is income from house property that is supposed to be deducted, supposed to be considered. So housing loan adjustment, this should be considered. And for salary, I feel we have written deduction allowed in the books, but the same has not been recorded. The same has not been recorded in a way. The same should be provided over here, which is in this case, here it should be not added, but should be deducted. So salary expense not provided in the books of account. So friends, the salary expense not provided in the books of accounts is 5,000 per month, which will be 48,000. 5,000 into 12. 5,000 into 12. So income. So the salary expense to be provided in the books of accounts should be 60,000, and the total income from PGBP will be 989, 9,89,000. Let's compute it. 9,89,000 minus, or first is the additions, 40,000 interest disallowed plus 14,000 as per 48.2 plus 48.3 won't be disallowed. Salary is separate provision. 2 lakh is to be added of depreciation. GST penalty is to be added, and then certain income are to be deducted. 10,000 dividend income, 1,50,000 agricultural income. Depreciation is nothing but 1,72,500 and 60,000, the provision of salary. So income from business or profession is 8,55,500, and income from house property will be, it's a self-occupied property. Accordingly, interest deduction will be allowed under section 24B, which will be 13,000, and 40,000 is the principal amount repaid. So 13,000 is the deduction amount over here, and gross total income is nothing but 8,55,500 minus 13,000, which is 8,42,500, and less deduction under chapter 6A, it will be 40,000. Accordingly, net total income will be 8,02,500. 8,02,500 is the net total income which will be taxable in the hands of the SSC for the assessment year 2021. Just to make sure we are not forgetting any adjustment, penalty has been considered, dividend has been considered, agricultural income has been considered, term loan, commission, cash of 48.3, then salary has been provided, principal repayment is provided, depreciation has been allowed. So friends, this concludes the solution of this particular illustration. So friends, the next illustration, Mr. Zivan is engaged in composite business of growing and curing coffee in India. The whole of coffee grown is in his plantation is cured, which is basically meaning after growing of the coffee, it is sent for further processing. Compute the income arising from such activities mentioned for the assessment year and show the WDV of the assets. This is the required part, and the person is into composite business of coffee. Particulars: WDV of car, WDV of machinery, both will be taxable at 15% rate. Expenses incurred for growing coffee, expenditure for curing coffee, and sale value of the cured coffee. So expenses have been mentioned and the sale value has been mentioned. And in the composite business of coffee, a ratio of 75-25% has been laid down as per rule 7B, wherein 25% will be taxable income and 75% will be agricultural income. Besides being used for agricultural operations, the car is also used for personal use. The car here is used for personal use. This allowance for personal use may be taken at 25%. The expenses incurred for running and maintenance is 42,000. So 25% of 42,000 will be personal use purpose, and the same will not be allowed for the purpose of computing the taxable income. The machines were used in coffee curing business operations only, so there was no personal use of machines, but another asset, which is car, was used for personal purposes. So friends, we have to compute the income from the composite business and the WDV of assets as on 1st April 2020. So here, let's start the solution. First is computation of WDV of assets. Here, first of all, car WDV as on April 1, 2019. It is nothing but 4,50,000. Then same was used as mentioned here. The same has been used for personal purposes to the extent of 25%. So depreciation will be on the entire value. Hence you will remember, while studying the actual cost of the asset, while studying the WDV of the asset, in section 43.6 there was an explanation 7, wherein the depreciation rate, the depreciation is to be calculated on the 100% of the value for the person in composite business. Initially there was a litigation wherein whether the composite business ratio, which is 75-25 in this case, should be applied on the depreciation rate as well. But thereafter there was a provision which was brought in, which is in explanation 7 to 43.6, section 43 clause 6. There was an explanation inserted wherein the depreciation will be calculated at the 100% value, and there will be no bifurcation of the WDV of the asset in terms of 75-25 ratio, and the depreciation will be calculated at the 100% of the WDV. Whatever depreciation is derived will be depreciation actually allowed to the SSE. So this is the concept of depreciation actually allowed to the SSE, which was brought in by explanation 7. So in this case as well, we will calculate depreciation at 15%, which is 4,50,000 into 50%. 4,50,000 into 15% on opening WDV is 67,500. However, 25% of the asset has been used for personal use. Personal use should be deducted from here. So 25% of 67,500, 16,875. It won't be allowed because it is not for business purposes. So net depreciation, you can say, will be 67,500 minus 16,875. 5625 is the depreciation which is eligible for deduction to the SSE. So WDV as on April 1, 2020 will be 4,50,000 minus 5625. It is nothing but 399,375. So this is opening WDV, or rather closing WDV of car. Now friends, next asset is machinery. In case of machinery, the opening WDV will be, the opening WDV is 12,50,000 and less depreciation, the rate will be 15%. 12,50,000 into 15%, 1,87,500. So WDV as on, WDV of machinery as on April 1, 2020 will be 12,50,000 minus 1,87,500, which is 10,62,500. Again, the concept of explanation 7 will be inserted, wherein depreciation will actually be allowed. Depreciation actually allowed will be on 100% of WDV. Also, the machinery was used only for the business purposes over here, which has been mentioned over here. Accordingly, there will be no bifurcation of personal use or business use. An entire depreciation will be allowed, and accordingly WDV of machinery is 10,62,500. Now this was the first part of the solution. Now computing the income arising from activities mentioned therein. So computation of income for assessment year 2021. Over here, sale value is nothing but 19 lakhs less expenses, which is nothing but for growing coffee. Expenses for growing is 3,30,000 less expenses for curing coffee is 2,90,000. So friends, less further expenses are depreciation on machinery, it's nothing but 1,87,500 less depreciation on car, which is personal use shouldn't be allowed, so 50,625. Then running and maintenance expenses of car, it's nothing but 42,000. 75% of it will be allowed, so 42,000 into 75%, 31,500 will be allowed as deduction. So now I feel we have covered everything which is related to the expenditure. Expenses for growing, expenditure for curing, sale value, running and maintenance, and to depreciation of machinery and car. So the composite income, total composite income will be, first is 19 lakhs sale value minus 3,30,000, which is expenses for growing coffee, minus 2,90,000 expenses for curing coffee, minus depreciation on machinery 1,87,500, minus depreciation on car 50,625, minus running and maintenance expenses 31,500, 110,375. So total composite income is 10,10,375. Out of this, business income will be 25% and Agricultural income will be 75%, which is as per Rule 7B of income tax rules. So business income will be 25%, which is nothing but 252,594, and remaining income will be agricultural income, which is 757781. 757781. The computation of income is bifurcated based on composite income. The income will be bifurcated in the ratio of 25% and 75% as per Rule 7B. So friends, the next illustration, which is related to computation of depreciation, additional depreciation, and computation of WDV of assets. On the screen, Triple T Limited is a newly established company engaged in the manufacturing business. So newly established, engaged in manufacturing business. Compute depreciation available under section 32. All the items are plant and machinery purchased by Triple T Limited. Also compute the WDV of the various block of assets as on 1st of April 2020. So compute depreciation and WDV as on 1st of April 2020. Particulars: new machinery purchased, new machinery installed on 21st of June 2019, new windmill purchased and installed on 1st of May 2019, depreciation rate is 40%, lorries for transporting goods to sales depot put to use in April 2019, it should be allowed. For the purpose of computing rate divided by 2, it has been used for more than 180 days. Items purchased after November 2019, this will help us to compute that following assets are less than 180 days. Accordingly, any rate, whether normal or additional depreciation, will be divided by 2. Forklift trucks used inside factory. Computers installed in office premises, installed in factory. Computer installed in factory only will be eligible for additional depreciation and not computers used in office premises. Also, this needs to be seen whether forklift trucks will qualify for additional depreciation or not, because if it falls under the definition of vehicles, then additional depreciation won't be eligible. And for your information, as per the Motor Vehicles Act, vehicles which are specifically used in factory, which are specifically used inside the factory, are not included within the definition of vehicle, and accordingly forklift trucks will be eligible for additional depreciation. This should be mentioned by way of a note in the solution. New imported machinery. The new imported machinery arrived at Chennai port on 30th of March 2020 and installed on April 2020. All other items were installed during the year ended 31st March 2020. So, since new imported machinery is not used for the purpose of business during the previous year, even eligibility of less than 180 days depreciation, that is divide by 2 rate, won't be applicable, because the asset has not been used during the year. So since it was installed on April 2020, the new imported machinery won't be eligible for any depreciation, be it normal depreciation or be it additional depreciation. And all other machineries were installed during the year, during the relevant previous year, which is 1920. So let's start with the solution. First we have to compute depreciation, right? So it will be allowable depreciation and it will be normal depreciation or additional depreciation. So first is computation of depreciation allowable under section 32, which includes normal as well as additional depreciation. Let's go asset wise. New machinery installed on 21st of June 2019, more than 180 days, and machinery assuming that it has been installed in manufacturing division. Additional depreciation will also be available apart from normal depreciation at the rate of 15%. Normal depreciation will be 15% and additional depreciation will be 20%. So new machinery installed, which will be, let's put this as this is part 1. First is, so we will have to compute normal depreciation, which is nothing but 50,000 into 15% and more than 180 days. Additional depreciation will also be calculated, which will be 50,000 into 20%. Right? And you should always mention reference to the particular section if you know it diligently. If you don't know it, if there is a guesswork involved, then better you do not write anything. But however, it is always recommended that you mention section, subsection. So the relevant section is 32.1.2, right? 32.1.1 is related to power units and 32.1.2 is related to other undertakings. Additional depreciation is 32.1.2a. So we will compute the depreciation, which will be 50,000 into 15%, 7,500 and 10,000. Fine. Second machinery, which is new windmill purchased. Depreciation rate has been stated already, which is 40%, and it has been installed in May 2019, so it will be more than 180 days. For this, normal depreciation 1 lakh into 40%, and assuming that it has been installed for manufacturing division, you can always mention a note therein. Depreciation, which will be 20%. So 40,000 and 20,000. It will be a different block of asset. So 40% block of asset, and over here there is 15% block of asset. Now moving on to the next asset, third part, which will be lorries for transportation. On this, 15% general rate will be applicable as plant and machinery. Normal depreciation will be 1 lakh into 15%, and on the same we are not eligible for additional depreciation being a vehicle. Accordingly, 15,000 is the normal depreciation. Fourth one, forklift trucks. Then forklift trucks won't be a vehicle, right? It won't be a vehicle as per the definition, as per the provisions of Motor Vehicles Act, which has been specifically included. Accordingly, it will be eligible for additional depreciation as well. So normal depreciation, friends, 50,000 into 15%, and the rate should be divided by 2 since used for less than 180 days. So 50,000 into 7.5%, 3750 is the normal depreciation, and additional depreciation is nothing but 50,000. In examination, you are not writing any short forms. You should be writing full form of normal depreciation and additional depreciation, as well as the format that you could use is columns could be additional depreciation and normal depreciation, and thereafter you can go ahead and compute depreciation asset wise. We are solving in this manner only because there is constraint in showing that particular format on the screen. So at the end, in the examination, the format won't matter. I mean, for at least for depreciation, it won't matter. If there is any specific format, I will let you know. For example, for computation of profit and gains or capital gains, profit and gains or capital gains or salary income, so there is a specific format to it which you will be already aware, which I will let you know at the time of solving specific problems. If there are no specific format, then you are free to use any specific format for solving a problem. So friends, forklift trucks, 20% divided by 2, it will be 5,000. Fifth point is computers in office premises, it will be 40%, no doubt. However, additional depreciation will be the difference, wherein normal depreciation is 40,000 into 40%, which will be divided by 2 as number of days used is less than 180. Accordingly, 8,000. No additional depreciation allowed since used in office premises. And computers in factory, over here normal depreciation is 30,000 into 40% divided by 2, and additional depreciation will be 30,000 into 20% divided by 2, right? So the amount over here should be 6,000 and over here should be 3,000. And in the next page there was new imported machinery for which we will have to put a note wherein since the asset has not been used during the relevant previous year, during the previous year 1920, since the asset has not been used, the same won't be allowed, the same won't be considered for the purpose of calculating depreciation. Fine. So we have covered all the assets, 6 assets to be specific, okay, on which we have computed normal depreciation and additional depreciation as applicable for these 3 assets: forklift trucks, computers in office premises, and computers in factory. They were put to use for less than 180 days, and accordingly, the depreciation rate is divided by 2. Fine. And the rate of depreciation is 40% for computers and 15% general rate for forklift trucks. And normal 3 assets: machinery, on which depreciation rate will be 15% and 100% depreciation rate will be allowed, new windmill and lorries. So okay, so friends, let's aggregate it and obtain the amount of depreciation which is allowable. So for depreciation for block of asset at the rate of 15%, and second portion will be at the rate of 40%. These are the two blocks of asset. So at 15%, we'll sum it up for normal as well as additional depreciation. First is 15%, which is 7,500. Just a second. Yeah. So 7,500 plus 10,000, which is 17,500. Let's mention it somewhere. 17,500. Then lorries, which is 15,000. So plus 15,000, which becomes 32,500. For forklift trucks, 3,750 plus 5,000, which is 8,750, right? 41,250 up till now. And computers, 40%. So depreciation for block of asset at the rate 15% will be 41,250, right? Now for 40%, these 2 assets I can see. So 8,000 plus 6,000 plus 3,000 will be 17,000, and 60,000. 60,000 plus 17,000 is 77,000. So additional depreciation is 77,000 total for the block of assets of at the rate of 40%. So this will be quantum of depreciation available under section 32 is total depreciation available under section 32 is nothing but 77,000 plus 41,250, 118,250, right? Now the second part was computing WDV as on April 1, 2020. Now first, do we have opening WDV? I feel no. No information is mentioned, and you can always say this that this is a new established. Accordingly, there will be no opening WDV, so it is nil. Then additions, which is new machinery. New machinery is 50,000. Then second is new windmill, which is 1 lakh. Lorries, 1 lakh. Forklift, 50,000. Computers, 40,000 plus 30,000, which is 70,000, right? So this will be open WDV nil, and addition of assets, total assets will be put it over here as assets sold as well. So you can say WDV as on March 31, 2020, which is nothing but 50,000 plus 1 lakh plus 1 lakh, which is 2 lakh 50,000, 3 lakhs, and 3 lakh 70, right? 3 lakh 70 is the WDV, and obviously assets sold is nil. So friends, depreciation allowable. Also, there should be a bifurcation among 40 and 15% over here, which we haven't done. So WDV should be as per the block of asset computed. Fine. So this WDV, we need the value, ideally WDV for block of asset at the rate of 15%, right? And WDV for block of asset at the rate 40%. So first is 15%, windmill is 40%, lorry is 15%, forklift 15%, and computer is 40%. So windmill and computer 1,70,000. 1,70,000 is block of asset at the rate 40%, and remaining amount, which is 2 lakhs, 3,70,000 minus 1,70,000, 2 lakhs is WDV for block of asset at the rate 15%, and depreciation will be deducted from it. So depreciation at the rate of 15% and depreciation at the rate of 40% is, we have computed this ahead, which is 41,250 and 77,000, right? 41,250 and 77,000 accordingly. WDV for block of asset at the rate 50%, 15% as on April 01, 2020 will be 2 lakhs minus 41,250, which is 2 lakhs minus 41,250, 158,750, 58,750, correct? And for the block of asset at 40%, 1,70,000 minus 1,70,000 minus depreciation is 77,000, which will be 93,000, right? So this is the solution for second part of the question. So friends, in the examination, it will always be better to prepare two columns wherein 15% and 40% are bifurcated, so that the length of the solution will be minimized and it will be easy for you to compute things. So friends, this is the solution for WDV computation, and for depreciation you can see computation of depreciation, this is the solution. Now friends, the next illustration, which is related to computation of total income, mainly related to computation of income from business or profession, whether the adjustments given, whether it will be allowed as deduction to the SSC or not while computing profit and gains from business or profession. Manufacturing Limited is engaged in manufacturing business. The profit and loss account of the company for the year ended 31st March 2020 shows a net profit of 20 lakhs. You are required to compute total income of the company for assessment year 2021, indicating reasons for treatment of each item. Fine. So compute total income, indicating reasons for each item, and net profit is 20 lakhs. Mr. A sales executive stationed at head office in Mumbai, was on official tour in Delhi from 31st of May 2019 to 18 June 2019 and September 19 to October 19 for the business development. The company has paid Mr. A's salary in cash. Mr. A's salary is paid in cash from its local office at Delhi for the month of May and September, amounting to 50,000 and 52,000 respectively, net of TDS and other deduction, as Mr. A has no bank account in Delhi. This was included in the amount of salary debited to profit and loss account of the company. So friends, here payment has been made in cash to the employee by the employer because he was on business development outside his normal place of duty, and also the posting is more than 15 days. If you can see, from 31st May to 18 June, there only it exceeds 15 days. Also September to October, also it exceeds 15 days. So for the purpose of section 48.3, read with rule 6DD, we have to determine whether such expenditure paid in cash, which is other than the modes prescribed under section 48.3, where expenditure is incurred in cash by the SSC, whether the same will be allowed or not to the SSC, and the expenditure over here is exceeding 10,000. So friends, there is an exception. When we were discussing rule 6DD, there was a provision wherein any salary payment to an employee who is temporarily posted outside his normal place of duty for more than 15 days, any payment in cash by the employer will be allowed, and also taxes thereon, TDS thereon is deducted by the employer. So in this particular example, you can see posting is for more than 15 days in each of the months. The normal place of duty of Mr. A was in Mumbai, and he had to go for the purpose of business development in Delhi for more than 15 days, and he didn't have any bank account in Delhi. So the expenditure has been incurred out of business expediency. It is for the purpose of business or profession. So in this circumstance, this specific scenario is covered in Rule 6DD, wherein an exemption has been provided to the SSC, and accordingly there will be no disallowance of any expenditure, even if it is other than the prescribed modes, even if the payment is exceeding 10,000. So this expenditure of 50,000 and 52,000 of salary payment, which is net of TDS, will be allowed to Manufacturing Limited. So the reason that you will have to specify in the solution will be, for first reason will be as per section 40A 48.3, read with rule 6DD, where a payment is made by the employer to the employee who is temporarily posted for more than 15 days at a place other than at a place other than normal place of duty. Accordingly, nothing will be disallowed. Accordingly, nothing will be disallowed in the hands of SSC, or you can say Manufacturing Limited. Also, applicable taxes are deducted and paid. There are on the salary, applicable taxes were also paid, which is one of the conditions for exemption as per Rule 630. Accordingly, this is the reason that you can mention while answering the solution. Fine. So next, so 20 lakhs will continue to apply to the company. So net profit 20 lakhs minus 50,000 and 52,000 will be available to the SSC. Second is the company has contributed 20,000 by account pay check to an electoral trust, and the same stands included under the head general expenses. For this purpose, any expenditure to trust, electoral trust, is specifically excluded and it won't be allowed for the purpose of calculating the business or profession. So 20,000 will have to be deducted from the net profit of 20 lakhs. So friends, 20,000 won't be allowed as deduction. The SSC will get a deduction under section 80 GTB for the amount contributed. It won't be allowed against the profit and gains income. However, it will be allowed against the gross total income, which is under section 80 GTB. Entire amount will be allowed to the SSC. Fine. So this needs to be taken care while we compute the total income of the SSC. So the reason to be mentioned over here is payment to electoral trust will not be allowed as deduction against the business and profession income. Same will be allowed as deduction under section 80 GGB. Third point is ABC Bank sanctioned and disbursed a term loan in the financial year 16-17 for a sum of 1 lakh. Interest of 40,000 was in arrears. The bank has converted the arrears interest into a new loan repayable in 10 equal installments. So the arrears of interest has been converted into a new loan. During the year, the company has paid 2 installments and the amount so paid has been reduced from funded interest in the balance sheet. So friends, here there is an actual payment of interest of, you can say, 2 installment, which will be arrears of interest of 40,000. So divide by 10, 4,000 plus 4,000, 2 installment, 8,000 rupees has been paid, actually paid by the SSC, which is in a way adjusted to fund interest account. It doesn't matter. Payment of interest under section 43B will be allowed based on actual payment made, and the mercantile system or the method of accounting followed by the SSC doesn't matter in those cases. So as per section 43B, interest actually paid will be allowed to the SSC. And here the loan was converted, the arrears of interest were converted into a new loan. That conversion won't at all amount to payment of interest. What would amount as payment of interest is the actual payment of interest, which are the two installments mentioned over here. Two installments has been paid. Accordingly, that will be allowed as deduction as per section 43B. Payment of interest to a payment of interest to a scheduled bank is allowed as deduction based on actual payment of interest, irrespective of method of accounting, followed by the SSC. Accordingly, interest of 8,000 will be allowed to the SSC, which is 40,000 divided by 10. So each installment is 4,000. Two installments are paid. 4,000 into 2 is 8,000. And conversion, you will also have to mention a note wherein conversion of arrears of interest into a new loan doesn't amount to payment of interest. Fine. This should be added to the note. Now, fourth point, the company remitted 15,000. The company remitted 50,000 as interest to a company incorporated outside India on a loan taken. Tax deducted under section 195 for such interest has been deposited by the company on 28th of June 2020. So, interest paid outside India, the amount was deducted, taxes were deducted during the previous year 1920. However, payment has been made in the succeeding previous year but before the due date of filing of return of income. Accordingly, as per section 40A(1), the same will be allowed as deduction to the SSC since the payment has been made before filing of due date of return of income. The said interest was debited to profit and loss account since the amount is deducted in the taxes deducted in the previous year 1920 and taxes deposited before filing of return of income, that is 28th June 2020. Accordingly, nothing will be disallowed under section 40A(1). Accordingly, 50,000 is allowed to be deducted, right? And fifth point is a group free air ticket was provided by supplier for reaching a certain volume of purchase. So free air ticket is provided by the group company, which is provided by the supplier for reaching a certain volume of purchase. The same is encashed by a company for 1 lakh in June 2019, that is in the relevant previous year. This has been received by the company during the business of profession or in the course of business of profession. The same has been received by Manufacturing Limited and the same has been encashed. Accordingly, a benefit is accrued to the SSC in the course of business or profession. Benefit accruing to SSC in the course of the business will be subject to tax under section 28. Accordingly, 1 lakh rupees should be added to the profit and loss account. So a note will be, fifth point will be amount encashed will be taxable under section 28 as the amount is received in the course of business, right? 6.1. A regular supplier of raw materials agreed for a settlement of 80,000 instead of 1 lakh for poor quality of material supplied during the previous year, which was not given effect in the running account of the supplier. Here, you can say 1 lakh was previously allowed as deduction to the SSC in the form of purchases made. However, the actual payment is only of 80,000. So 1 lakh minus 80,000, 20,000 is a benefit in the hands of the employee. It will be deemed profit in the hands of the employee under section 41(1) as a benefit is arising to the SSC by way of remission or cessation of trading liability, right? So 6 point amount of 20,000, which is 1 lakh minus 80,000, will be a benefit from remission or cessation of a trading liability, right? Accordingly, it will be taxable. It will be deemed profits under section 41(1). Also, it has been mentioned that the effect has not been given in the books of accounts of supplier. So as per the provisions of 41(1) explanation 1, it has been specifically mentioned that even if nothing has been mentioned in the books of accounts of the other person, it doesn't matter. If the SSC has taken into account the reversal of the liability, then it will be considered as a benefit in the hands of the SSC. The term used over there is unilateral act. So the tax liability which is reversed, not a tax liability, the liability which is reversed, which is a benefit in the hands of the SSC, even a unilateral act will be considered as a benefit. So you can say transaction where this transaction is not given effect, in the books of accounts of the supplier, of the concerned supplier. It does not matter. It does not affect the taxability. Taxability is unilateral act. Taxability, okay, as unilateral act will be considered for the purpose of taxability or deemed profit. As unilateral act will suffice for considering taxability of the deemed profits. So even the unilateral act which is mentioning of this transaction only in the books of accounts of the SSC, that will be fine for taxability under section 41(1). So friends, 20,000 from 6th adjustment, 1 lakh from 5th adjustment, right? These are supposed to be considered in the profit and loss account. 4th adjustment is fine, nothing will be deducted, right? Installment of 8,000 for 3rd adjustment will have to be deducted as per section 43B. Point 2 adjustment 20,000 will have to be deducted and a separate adjustment will be added back, and separate adjustment under 80 GGB will be considered for computation of total income, and Mr. A's salary has been rightly deducted. So over here, computation of total income, just a summation of what we have done, and this is what has been asked in the solution as well. Computation of total income of manufacturing limited for assessment year 2021. So net profit is nothing but 20 lakhs at expenditure disallowed, or you can say income which is exempt, expenditure which are disallowed, and income not considered. Income not considered, first portion will be allowed anyways, that's not an issue. What is to be added is 20,000 is to be added, payment to electoral trust, which is to be considered separately, payment to electoral trust, which is 20,000, right? Then what is to be added further? Third adjustment, 8,000 will be deducted. Fourth adjustment, remitted outside India, this will be allowed as deduction. Said interest was debited, so no adjustment required. Fifth and sixth, fifth is an income, 1 lakh is to be considered and 20,000 is income. So 1,20,000 will be added over here, right? So second part is encashment of free tickets, right? Which will be 1 lakh, right? Then last was remission benefit, you can say deemed profits under section 41(1), which is 20,000. This was supposed to be added, and less will be expenditure not considered or income exempt. Not considered or income exempt. So first and only point is interest paid in 2 installments, which will be 8,000. This should be deducted. Accordingly, income from profit and gains from business or profession, right, will be 20 lakhs. Addition is of 1,40,000, which is this, right, and deduction of 8,000. So friends, amount will be 20 lakhs plus 1,40,000 minus 8,000, which is 21,32,000, right? And this will be gross total income. This will be gross total income. Yes, there is no information or other than income from profit and gains. Thereafter, less deduction under section 80 GGB for contribution to electoral trust, which is 20,000. 20,000 is nothing but is to be deducted. So net total income of manufacturing limited for assessment year 2021 is nothing but 2132 minus 20,000, which is nothing but 2112,000. So this is the net total income of the SSC for the assessment year 2021. So moving on to the next illustration. For assessment year 2021, examine the taxability and or allowability of following receipts or expenditure. First, so these are independent cases wherein we will have to determine taxability or allowability of expenditure not only from the angle of the payer but also from the angle of the payee. So both the angles we need to see and answer accordingly along with suitable reasons. First one is Kangaroo Limited receives a sum of 5 lakhs from Tiger Limited on December 2019 for agreeing not to carry on any business relating to the business of Tiger Limited in India for the next 2 years. So the payment is for agreeing not to carry on any business. Kangaroo Limited is in receipt of the amount, and this will be termed as non-compete fees as per section 28(5)(a), wherein the same will be taxable as profit and gains from business or profession in the hands of Kangaroo Limited, because this specific situation is already covered under section 28(5)(a), wherein the non-compete fees will be subject to tax in the hands of Kangaroo Limited. And from the perspective of Tiger Limited, same will be termed as an expenditure and will be allowed as deduction in the hands of Tiger Limited, provided applicable taxes thereon has been paid, meaning Tiger Limited's responsibility will be to deduct tax, deduct TDS while making payment to Kangaroo Limited, and the applicable section in this case will be 194J, right? Only if TDS has been deducted, then only Tiger Limited will be allowed this deduction, else it will be disallowed under section 40(a)(1)(a). 30% of the amount will be disallowed, right? So these are the implications from the perspective of Kangaroo Limited and from the perspective of Tiger Limited. So in the reason section, you will have to mention that Kangaroo Limited, I will just mention a note over there. I will just provide the crux of the situation, right? So that you can, in your own words, write a reason for the solution. First is Kangaroo Limited. Amount received will be taxable. Amount received will be taxable in the will be taxable under section 28(5) 28(5) of the Income Tax Act 1961, right? Nature of receipt being a non-compete fee, and for Tiger Limited, amount paid will be allowed as business expenditure, right? Paid during the previous year, which was on 31st of December 2019, paid during the previous year 1920, provided applicable TDS is deducted and paid thereon. TDS is to be deducted under section 194J of the Act. Here you can always define the Act, which is the Income Tax Act, and then you can mention under section 194J of the Act. So for Kangaroo Limited, the amount received will be taxable as non-compete fee, and for Tiger Limited, the amount paid will be allowed as deduction since it is related to the business in the course of the business and it has been paid during the relevant previous year, provided applicable taxes thereon are deducted and paid by the company. Now the next one, Parrot Limited paid 20 lakhs as sales commission for the year ended March 2020 without deducting tax at source. So here no taxes have been deducted. So the amount will be disallowed in the hands of the SSC if the same is chargeable to tax. So first we will have to determine whether at all any taxes were to be deducted, but prima facie it could be a case there may be a disallowance under section 40A1A, and also I just recalled that note also for Tiger Limited can be mentioned that if applicable taxes are not deducted by Tiger Limited, then the same will be disallowed under section 40A 1A since the payment is to a resident entity. If the payment is to a non-resident entity, which the point will be getting covered in point number 2, if TDS has not been deducted where the payment has been made to non-resident, then the applicable section is, yes, 40A1, right? And the disallowance will be 100% and not 30%. So here taxes have not been deducted. Payment has been made to Mr. P, who is citizen of US and non-resident, who acted as agent for booking orders. So till here it could be a case, still it could be a case that if taxes are not deducted, then there will be a disallowance in the hands of Parrot Limited, because in the hands of non-resident also Indian source income is taxable. So if there is any Indian source income, then non-resident is subject to tax in India, and accordingly applicable taxes were liable to be deducted and paid by the payer. Now here, from various customers who are outside India. So this sentence is very much important, wherein Mr. P, the agent, has procured orders for customers who are outside India. So the source of income is outside India and not in India, right? And the residential status of Mr. P is non-resident of India. Accordingly, nothing will be taxable in the hands of Mr. P. Accordingly, nothing will be disallowed to Parrot Limited, only because nothing was chargeable to income tax, and accordingly nothing will be disallowed in the hands of Parrot Limited. So friends, note what you can mention over here is, second point is, in the hands of Parrot Limited, as the orders were procured by Mr. P for customers outside India, and and Mr. P is a non-resident in the relevant previous year, which is 1920. Accordingly, nothing is accordingly payment of 20 lakhs is not chargeable to tax in India in previous year 1920. Accordingly, no taxes are required to be deducted by Parrot Limited, and nothing will be disallowed under section 40A1. So there could have been a possibility wherein the expenditure may have been disallowed at 100% if the amount was chargeable to tax, since Mr. P is a non-resident and there is no income source in India. The payment is not sourced out of India. Accordingly, the amount on this amount TDS is not liable to be deducted. Accordingly, 20 lakh rupees will continue to be allowed as deduction to Parrot Limited, right? And for Mr. P Limited, you can always mention that he is a non-resident and no income source in India. Accordingly, nothing is taxable in the hands of Mr. P, part of which we have already covered in the para of Parrot Limited, right? Now, secret commission paid. This is the only sentence, and this concludes this illustration part. So, secret commission paid is something which is paid by the company where there is benefit arising to the particular entity. For example, suppose for a tender, several companies are required to bid their amount to obtain the tender. Now, the company which is the government, you can say government or any private company who is rolling out the tender, one of its employee leaks the information that the minimum bid price till date is say 10 rupees. Okay, and this information is not leaked in general public, but this information is leaked to the relevant SSC, and the SSC based on this information bids a lower amount and obtains the tender, and the entity pays a secret commission to that employee who has provided him the information. So in this case, friends, there is a possibility that this payment can be termed as illegal under explanation 1 to section 37. So this was one of the example I'm trying to say, but from the nature of the payment or the wordings that has been used as secret commission paid, then the word secret may lead to a conclusion that it may be an illegal payment which is not allowed as per explanation 1 to section 37. If it is a normal commission paid by the entity for business purposes during the previous year, then it will be allowed to the entity. However, if it can be contended that it is an illegal payment, then it will be disallowed in the hands of the entity. Correct? So, secret commission paid in this case will be allowed to the payer, will be allowed as deduction to the payer if the payment is related to business. Here the question, there is nothing has been mentioned whether the payment is related to business, whether the payment is illegal or not. So we will have to assume and provide our reasoning. So, will be allowed as deduction to the payer if the payment is related to the business of the payer, right? And payment is made in the relevant previous year. It will be allowed. However, if the payment, if it can be contended meaning argued, if it can be put forth, contended, argued that the payment is illegal in nature, the example that we gave, the example that we discussed. So if it can be contended that the payment is illegal in nature, then will be disallowed. Under explanation 1 of section 37, right? This was in the hands of the payer, in the hands of the page. Now we do not have any clarity to whom the payment has been made, right? And if the payment has been made, it's not to the employee. Generally, if the payment has been made to SSC, this may be taxable as income from other sources, because in our example, we gave an example of payment to an employee. Between the SSC and the employee, if we see, there is no employer and employee relationship, so nothing will be taxable under that salaries. However, it will be taxable under the head income from other sources, right? So for the person who is receiving the amount, the payee, the amount will be taxable as income from other sources, and for the payer, if it is not illegal in nature, then it will be allowed as deduction to the payer in the year of payment, since it is in the course of business. So friends, this concludes this illustration. Now friends, in next illustration, on your screen, compute the income chargeable to tax for the assessment year 2021 of Hector Limited. Ignore MAT. So this is the requirement in which we have to compute the total income in the hands of Hector Limited, trading and profit and loss account of the company having business of agricultural produce and other products for the year ended 31st March 2020 is as under. Fine. Opening stock, purchases, freight and cartage, gross profit, sales, closing stock. It's the trading account. Profit and loss account, advertisement, gross profit, bad debts, bonus to staff, rent of premises, GST, interest on loans, depreciation, miscellaneous expenditure, net profit, income tax refund, warehousing charges. So probably you can highlight this. This is the adjustment, right? Warehousing charges, the nature needs to be determined of this. The income has been received by the SSC in the terms of warehousing charges. Then this depreciation will be reversed, since it is, you can say, as per Companies Act. So it will be reversed, and as per Income Tax Act, whatever is the depreciation needs to be deducted. So this will be added, right? And net profit is 20 lakhs 2000. Now adjustment. As you can see, there are several adjustment, 10 adjustment, and in examination you will have to, as a process, what you can do is, while solving the problem, first read the entire question. Wherever you want to highlight something as a part of adjustment, you can mention it over there. For example, as we have done in these cases, wherein this could be an adjustment part, wherein to the net profit, for the purpose of income tax computation, this amounts will have to be added. For example, income tax refund, it is not taxable per se. Only the interest from income tax refund will be taxable. So it will be deducted from the profit and loss account, from the net profit. Also depreciation, since it is not as per Income Tax Act, it is to be deducted while computing profit and gains from business or profession. And there will be several adjustment which is coming up. So here, as a process, what you can do is, while reading the adjustment, you can put a plus or minus sign in front of the adjustment, so that while preparing the format, while computing the profit and gains from business or profession, you can come to know immediately whether what is to be added and what is to be deducted. What will be deducted will be expenses which are not allowed or income which are exempt, right? So in this case, depreciation as per income tax will be deducted, income tax refund will be deducted, as it is not an income which is taxable, right? Just an example. And what will be added will be expenses disallowed or income which are not considered in the profit and loss account. So put a plus, put a minus sign against the adjustment, and you will have to read as a process. Please read the question again, so that before starting the solution, you will be sure that what is prima facie, what is the solution, and how do you want to approach to the solution, right? Because in the examination you will have to adhere to a format. Format for profit and loss account is, format for computing the income from profit and gains from business or profession is, first you will have to take net profit. So you will have to prepare a table, particulars, amount outer column, and amount which is a final column. These three columns will be prepared. Then net profit as per profit and loss account. Then add the expenses which are disallowed, which are to be disallowed, or income which are not considered, less the expenses which are not considered or income is exempt. And thereafter you will derive the final tax liability, final income. And in this solution we have been asked to compute total income chargeable, right? So starting with the adjustments, advertisement expenses, you can highlight this, include an amount of 2500 paid for advertisement published in a souvenir issued by a political party. The payment is made by way of an account pay check. So friends, it will be straightforward, disallowed as per provisions of Income Tax Act, as per provisions related to profit and gains, and it will be allowed as deduction under 80 payment to political party, right? So I cannot put a plus sign or minus sign over here. If at all, what you can do in your note section, I hope what you are doing is you are simultaneously solving this solution. So you should have a book with you, paper, scale, calculator, and pen. Draw the format, right? Before starting the solution as a protocol, what you should be doing is, you can pause the video before I start the solution, prepare the format, and start making pointer notes while you do. In the notes section, you can always mention advertisement. I mean, you will get a question sheet in the examination. But here, you have screen in front of you, nothing, you won't have any hard copy with you while you are going through these tutorials. So what you can do is, in your book, mention that what adjustment will be required and what adjustment are not required. So that will help you out in solving the solution, and try to solve it independently. From this you will come to know that on which part you are going wrong, and accordingly that mistake you won't commit it again while solving in the examination, because in the examination it will be like it's a huge question. It will take 5 minutes of yours to entirely read the question, so you will be time bound. Here you are not time bound, you are learning, but since the provisions have already been discussed with you, then you should attempt to write the solution, to provide the solution independently. This will help you in examination. So advertisement expenses includes an amount of 2500 which should be disallowed, so it will be deducted, so a minus sign over here. Bonus to staff includes an amount of 6000 paid in the month of November 2019, which was provided in the books on 31st of March 2019. So friends, it pertains to based on mercantile system of accounting followed by the SSC. It has been provided in the books of accounts in the previous year 1819, right? And the payment has actually been made by the employer only in November 2019. So ideally, if we see what the provision of 43B says is, the payment should have actually been made by the employer. Only if the payment of bonus has been made by the employer, it will be allowed to the SSC, and the payment should be made on or before the due date of filing of return of income. Here the due date has already passed. The due date of previous year 1819 will be ideally August, right? August 19, provided the company is not into transfer pricing report. I mean, transfer pricing report is not applicable. Let's assume it. So the payment is after the due date, and accordingly it hasn't been allowed in the previous year 1819. So what about previous year 1920? Since the actual payment has been made, it will be allowed based on payment basis to the SSC. So this expenses will be allowed to the SSC. 6000 will be allowed. So there is no adjustment as such on this. I'm not highlighting it. Survey under section 133A on 31st March 2020 revealed that value of closing stock of 31st March was 6 lakhs, and sale of 1 lakh made on 10th of March 2020 was not recorded. So adjustment on closing stock, where SSC had undervalued closing stock and actual value is more. If you see, closing stock is 2,50,000 over here. Even the sales value will be adjusted. Closing stock was 2,50,000 only, so it was undervalued, and as per the survey, when actually the closing stock was valued, it was the amount is 6 lakhs. Sale value of 1 lakh is not recorded, so it needs to be considered. Value of closing stocks after considering these facts and on the basis of inventory prepared. The closing stock of 31st March 2019, so it will be a opening stock, friends. So opening stock over here is 2 lakhs. So again it was undervalued, right? And the value of closing stock after considering these facts and on the basis of inventory prepared by the department on 31st of March 2020 worked out 6 lakh 50. So closing stock of 6 lakh 50, which was accepted to be correct and not disputed. So this will be the final figures as opening stock, closing stock and sales value. So you will have to recompute the gross profit. So obviously there will be an effect on net profit. So this is supposed to be adjusted as an adjustment, right? So instead of going item wise, I mean opening stock separately, sales price separately or closing stock separately, what you should be doing is compute gross profit, which is a revised gross profit, and then the amount obtained will be adjusted against the net profit. So whether added, whether deducted, we will come to know once we solve, once we prepare the revised trading account of the SSC, right? So even this is part of adjustment. Fourth, income tax refund includes 5,000 of interest allowed thereon. So here you can see income tax refund as such won't be considered as income as we have discussed earlier. It won't be taxable under from income from other sources as well. So the amount which is reflecting in profit and loss account is not to be considered as an income. First, that is the adjustment, and thereafter interest income, which is part of the income tax refund. Whenever the government pays you refund, since suppose let's say they have paid the amount after 1 year of filing of return of income, so applicable interest thereon is paid by the government. So whatever interest part is paid is taxable under that income from other sources. So this adjustment will come into picture while we compute total income, right? So even for one first adjustment, there is part of the payment of 2,500 will be allowed under ETGGB. Similarly, for fourth adjustment, the amount should be considered for total income purpose. You can mention it near the adjustment in the examination. For the time being, you can mention in your working note section. Okay, this is also the adjustment that you need to keep in mind. Now the next adjustment, rent of premises includes an amount of 6,000 incurred on repairs. Fine. So the premises, or you can say the premises which is used, the building which is used for the purpose of business or profession has been rented, is on rental basis obtained by the SSC, and there are repairs expenditure over there. SSC was under no obligation to incur such expenses as per rent agreement. This wording is important. Since SSC is not the owner and is incurring repairs on it which may be used for the purpose of business or profession. However, since as per the agreement can be concluded that such expenditure was not at all required to be done by the SSC, in such a case, such expenditure will be disallowed to the SSC, and accordingly, under section 30 if you see, nothing will be allowed. However, it may fall under section 37. So not specifically under section 30 or 31, but it can be specifically covered under section 37. So in a way it will be allowed, but in different section. So assuming that the same has been incurred for the purpose of business or profession, then it will be allowed under section 37. Prima facie, if I see whether it is to be allowed under section 31 or not, then it will be disallowed as per section 31 only because of the highlighted portion, as there was no obligation of the SSC to expend this amount, right? Now next is miscellaneous expenses include amount of 10,000 paid towards penalty for non-fulfillment of delivery conditions of a contract of sale for the reasons beyond control. So for the reasons beyond control, penalty was supposed to be paid. A penalty is paid by the SSC. In this case, it can be contended since there are reasons beyond control. You can say due to the ongoing scenario of COVID, there was a delivery scheduled in, let's say, April, May, right? And at that point of time, the SSC was unable to honor his delivery commitment because staff is not available. So in this scenario, friends, These are reasons beyond control of the SSC, and accordingly, such penalty, if at all he has paid on the basis of contractual obligations, won't be disallowed. So this will continue to stand. This is rightly claimed as expenditure. Amount of 80,000 paid to the relative of director who is working as junior advocate for taking an opinion on a disputed matter. The junior advocate of high courts normally charge only 20,000 for the same opinion. So reasonable expenditure, if you see, is 20,000. However, 80,000 has been paid to a specified person. Specified person herein is director of a company, relative of a director of a company. Accordingly, 40A2 will be invoked and anything excess paid will be disallowed. So 80,000 minus 20,000, 60,000 will be disallowed to the company. Amount of 1 lakh. So even this is an adjustment. Amount of 1 lakh paid to Electoral Trust by check. Though here the payment has been made in check, which is other than cash, so prescribed mode has been used, but the relevant section in which the deduction should be claimed is 80 GGB. Accordingly, it will be deducted from net profit and allowed as deduction while computing total income. So even this is adjustment. Interest on loans includes an amount of 90,000 on which tax was not deducted. So you have paid an expenditure on which applicable taxes are not deducted. It will be straightforward disallowed in the current previous year. It will be allowed only when applicable taxes are deducted and paid in the previous year in which the applicable taxes are deducted and paid by the SSC. So this will be disallowed. Interest on loans, since taxes are not deducted. GST demand includes an amount of 5,000 charged as penalty for delayed filing of returns and 10,000 towards interest for delay in deposit of tax. So two amounts, penalty and interest. Penalty, as we are aware, is never allowed, and interest over here will be allowed to the SSC. So only penalty part will be disallowed and interest portion will continue to be allowed. The company has made an investment of 20 lakhs on the construction of a warehouse in a rural area for the purpose of storage of agricultural produce. So rural area for the purpose of agricultural produce, there is a capital expenditure of 20 lakhs, right? This was made available for use from 15th of August 2019, which is in the relevant previous year, and the income from this activity is credited in profit and loss account under the head warehousing charges. So the income has been considered by the SSC in the books of accounts, and expenditure has been incurred, capital expenditure has been incurred for a specified business, which will qualify under section 35 AD. So any expenditure for a specified business by the SSC during the previous year will be allowed as deduction under section 35 AD. So this 20 lakhs amount will be allowed as deduction in the previous year only because the production has also commenced in the relevant previous year, which is it started on 15th of August 2019, and accordingly 20 lakhs will be allowed as deduction under section 35 AD. So the adjustment related to warehousing charges which we had marked in profit and loss account is this. The exact nature is provided in adjustment 9. Depreciation under the income tax act works out at 75,000. So this amount will be deducted. So friends, better in examination you start reading the solution again, reading the question again. This will, ideally it won't take that time in detail, but somehow you will be sure that what adjustment is supposed to be considered while computing the income of the SSC. So friends, let's start with the solution. So here, first we will start with the adjustment part, right? So over here, so first we will compute profit and gains income, computation of profit or gains from business or profession, right? For assessment year 2021, first is obviously you will in your format. What you are supposed to do is, I hope you have already prepared the format, particulars, and then you can mention amount over here and amount in the total column. So this should be the format. Then net profit as per profit and loss account. I'm just deleting it, but in your solution it will be continued that you prepare two columns for amount, one outer column and one inner column. Net profit as per profit and loss account. In the outer column it is the amount is 20 lakh 2000, 20 lakhs 2000, right? Then add expenses disallowed, income not considered. First, advertisement, it will be disallowed. So advertisement expenses disallowed as per section 37 to AB, 37 to B. So advertisement expenses disallowed as per section 37 to B and considered separately under section 80 GGB. So the amount, this amount is supposed to mention in a column, right? So this amount will be added. Then comes second, which is bonus to staff. Since the amount has been paid during the previous year, though it had been provided earlier, but it has been already disallowed in previous year 18-19, and on payment basis it will be allowed in the current previous year. As per section 43B will be allowed on payment basis to the SSC, right? So amount will be nil because it has been correctly considered in the books of the accounts. Now the next adjustment, third, closing stock, opening stock and sales. You have to compute the revised gross profit. Here we don't know whether it is to be added or not, right? So what you can do over here is, and for the time being, you can compute this amount. What you will have to do is, you have to compute this amount in the working note. Go to your working note section. So ideally first and second page will be reserved for your format, for this particular format, and from the third page, the working note. On a safe basis, you can keep the third page as well for the purpose of this format, because it may be possible because there are 10 adjustments and you are also mentioning notes in this section. So it may extend to third page as well. Either you can choose to mention the notes section in the working notes only, or you can mention in the format itself. You have the option. So if you want that, the format is not extending beyond the second page, then you can ideally mention the notes in the working notes section. In that case, you will have to juggle between page third, page second, page third. So this is how it will work. So to confine your format to first and second page, you can mention the notes always in the note section. So go to your working note section and prepare this working of revise gross profit. For simplicity purpose, I am mentioning over here only, but in your solution, you should be mentioning it in the working note section. So if we recompute the profit and loss account, opening stock is nothing but 6 lakhs, which is the revised one. This is my credit side of the trading account, and the closing stock amount will be 6,50,000 as mentioned in the adjustment. Then purchases, there is no change in this, so you can always mention as per the solution. The purchase account over here is 5 lakhs and sales is 70 lakhs. 5 lakhs sales will be 1 lakh was not included, so 70 lakhs plus 1 lakh, right? And expenses, what are the expenses? Freight is the only expense which there will be no change. So this is 50 lakhs, not 5 lakhs. Purchase is 50 lakhs and freight is 1,26,000. So the amount is 50 lakhs and freight is nothing but 1,26,000. So your gross profit should be 6,50,000, which is the closing stock. Sales 71 lakhs. Total is 77 lakh 50,000 minus 6 lakhs opening stock minus 50 lakhs purchases, and freight is 1,26,000, which will be deducted. So 20,24,000 is the gross profit, and the amount which is derived in the solution in the question paper is 19,24,000. So it will be compared with the gross profit 19,24,000, right? Yes, 19,24,000, and you have 20,24,000. Gross profit as per profit and loss account is nothing but 19,24,000. So this amount is to be added. Amount, you can say income which is not considered, right? After giving effects of adjustment 3 to opening stock, to closing stock, to sales value, after all this adjustment, the revised gross profit is 20,24,000. It has been compared with the existing gross profit as per profit and loss account, which is 19,24,000. The remaining amount, which is 1 lakh, is to be added to the net profit. So I will mention it over here and bold it so that at the time of solving we come to know. So we have this amount. Expenses have been added. First, second, third adjustment has been made. This working note you will prepare in your working note section, and while mentioning the amount over here, mention your working note number. Continuing with fourth solution, fourth adjustment, income tax refund is supposed to be deducted, not added. Right? So in this section you won't be appearing this. I mean, this amount won't be appearing. It won't be added over here. It will be appearing in the section of less expenses not considered, income which is exempt or not to be considered. So it will be added back. It will be deducted from there. So in this section both adjustment won't be coming, it will be coming at a later point of time. So we will have to keep this in mind. That's why the importance of addition and deduction. So first, second and third were supposed to be added. Second obviously has no adjustment. First was supposed to be added, which was disallowed, accordingly to be added. Third, since income, you can say gross profit was undervalued, accordingly it has been added. It will have an effect of adding the net profit, right? And fourth is to be deducted, which you will be considering it separately, right? Now let me copy this, and while we are moving on the next adjustment, we can copy paste over here so that we are continuing with the solution, right? So the fourth adjustment, not over here, we'll have to consider it separately. So the fifth adjustment, continuing rent of premises, it will be allowed, as we have discussed, as per section 37 it will be allowed, provided it has been incurred for the purpose of business or profession. So friends, again it will have no adjustment as such. A format has been changed over here. Yeah, now it is proper. Okay, fine. Now it is perfect. So the fifth adjustment, rent of premises. Rent of premises, since have been incurred. Rent of premises, repairs on rent of premises. Yeah, repairs on rent of premises paid by SSC. Paid by SSC. Repairs on rent of premises paid by SSC will be disallowed as per section 30A. However, assuming that the same is incurred for the purpose of business profession, for the purpose of business, it will be allowed under section 37. And since adjustment has already been considered in the books of accounts, nothing will be considered. There will be no adjustment as such. So whatever treatment is considered in the books of accounts is correct. Now the sixth adjustment, sixth A, you can say, amount of 10,000 paid towards penalty for non-fulfillment of delivery conditions of a contractual sale which is beyond control, as we have discussed. Since there were reasons beyond control of the SSA, in our example we gave COVID example, so the SSC is not able to honor the contractual obligations and there was a penalty charged, though such penalty will be out of business expediency to retain the client, to retain the existing client for the course of business or profession. Accordingly, same will be allowed. Accordingly, penalty paid for breach of contractual obligations, penalty paid for breach of contractual obligation is allowed if penalty was for breach of law, then it will be disallowed. Correct? So this adjustment is also correct, as miscellaneous expenditure already includes this amount. 80,000 paid to relative of director, this is excessive, it will be disallowed as per section 48(3). Anything in excess should be disallowed. Correct? So friends, as per section 48(3), 48(2), 48(2), excessive amount paid, excessive or reasonable amount paid to a specified person to a specified person, right? In this case, it is relative of director will be disallowed. This is the reasoning, and accordingly 80,000 minus 20,000, 60,000 will be disallowed. So it should be added back. 6C, electoral trust, again it will be disallowed. Amount paid to electoral trust will be considered separately under section 80GGB. Accordingly, it should be added. This amount you need to keep in mind. So these are the two adjustments. Seventh, interest on loans includes an amount 90,000 on which taxes are not deducted. So since taxes are not deducted, and assuming the payment has been made to a resident, the disallowed amount will be 30% as per section 40A1A. Amount to be disallowed, you can say interest amount to be disallowed as taxes are not deducted. Amount to be disallowed is 30% of the expenditure as per section 40A 40A1A. 1 is for non-resident, and assuming since information has not been provided in the solution, we will have to put a note assuming the payment is made to resident. Accordingly, 90,000 into 30% is nothing but 27,000. It is to be added since it is disallowed. Now next adjustment. So friends, moving on to the next page. Here you can see GST penalty and interest. Penalty due to breach of law will be disallowed and interest will be allowed. So the amount is 5,000 which will be disallowed, right? And 9th is 35 AD, 10th is depreciation. So two adjustment. There are a lot of comment section over here. This is relevant for us. So 8th point is breach of law. GST penalty, you can say GST penalty for breach of law. So GST penalty for breach of law will be disallowed, and interest penalty, interest on GST will be allowed. Delay in deposit of tax will be allowed, and over here, so only the disallowed amount we will mention over here, right? What is the amount? 5,000. Then comes the adjustment of 35 AD. Income from 35 AD should be considered separately because it is income from specified business. It becomes more relevant because any loss from specified business is to be set off only against the income of specified business. So any income, any computation related to a specified business should be computed separately and not should be included in the profit and loss from the normal business. So here you can say the SSC has specified business and normal business. So we are computing for now profit from normal business, and accordingly warehousing charges, which is reflecting as income in the profit and loss account, will be deducted for the time being and it will be computed separately. That's the only intention. So here we won't have any adjustment as such. In the adding part, meaning the expenses disallowed, income not considered, in that portion it will have no effect, but it needs to be kept in mind at a later point of time, right? So in the less section, no adjustment, but in add section, yes. And thereafter depreciation. Depreciation as per books of accounts, as per income tax, we will consider it separately. But as per books of accounts, the amount is 70,000, right? 70,000 is the amount. So this is the expenses disallowed section or income which are not considered. So let's go through the last adjustment. Eighth adjustment is done. Ninth adjustment to be considered. So fourth and ninth adjustment are pending. Depreciation 10th adjustment is also pending of 75,000. And if we have a look at trading and profit and loss account, we have already revised this. Advertisement is done. Bad debts, bonus, rent, GST, interest on loans. It has been disallowed at 30%. Interest on loans adjustment. This is not the entire amount, right? Includes 90,000. On 90,000, 30% will be disallowed. Fine, this was correct. Depreciation, miscellaneous expenses, net profit, income tax refund. This has already been added. Warehousing charges. Income tax refund will be deducted. So there has been no adjustment of it, right? There has been no adjustment of the income tax refund yet, which will be considered separately in the coming part. Yes, so fourth part, the fourth part, right. So this will be added. The amount is, or let it be add section. Now the next part is expenses not considered, or you can say income exempt. So 10th part is the fourth solution. Income tax refund is not taxable. Accordingly, it will be added back, and interest on such refund will be taxable under income from other sources. So it will have to be considered at the time of total income. So the amount is 25,000. Warehousing charges 11 lakh 25,000. So 25,000 it is to be deducted, and here you will have to mention it over here less. It should be less, right? Income tax refund. Then the solution that we had to skip was warehousing charges. Warehousing income, you can say 11 lakh 25,000, which has been booked in the profit and loss account, right? So it will be deducted. And regarding to that, the adjustment is going on to the adjustment part. Okay, 20 lakhs minus 11 lakh 25,000 is the amount which will be lost from specified business, right? So I will mention it over here. I mean, it would be mentioned in the separate working notes. Let's consider it at the time of computing total income. The adjustment of loss from specified business. Loss because 20 lakhs is the capital expenditure, and income from the warehousing charges is 11 lakh 25,000. Accordingly, we have 20 lakh minus 11 lakh 25,000. Whatever is the amount is will be loss from specified business under section 73A. Such loss can be adjusted only against a specified business income. Accordingly, nothing will be adjusted against the profit of normal business. That you need to keep in mind. So warehousing income, interest on loans, any adjustment left, depreciation is left of 75,000, depreciation 12, this depreciation as per income tax act 75,000, correct, and this should be kept in bold, and this amount. So we have considered all the adjustment now, which will be affecting the normal business, normal profits. Just rechecking it. Advertisement, bonus to staff, survey, income tax refund, that will be considered separately. Rent on premises, Miscellaneous expenses beyond control 80,000, 1 lakh, 80 GGB. 80 GGB, there are two amounts. Interest on loans 30% will be disallowed. So ideally, if you see, 70% will be allowed and 30% disallowed. Accordingly, we have added back 30% for seventh adjustment. So it is correct. GST 3580 is pending from my end only. That's it. And the total income. So friends, total income that we will have to consider over here is, first of all, net profit from the normal business, you can say. It is nothing but the amount will be, we'll have to add and subtract over here. So considering from start, 20 lakh 2000, add 2500 advertisement expenses. Second, there is no adjustment of bonus to staff. Then amount of revised gross profit is 1 lakh. Then fifth, there is no adjustment, 1,60,000. 6B, 6C, again 1 lakh. So 2,60,000 is to be added. So 20 lakh 2000 plus 2500 plus 2,60,000 plus 27,000, which is 30% interest payment disallowed. GST penalty 5,000 and depreciation 70,000. So 75,000 to be added. Then what is to be deducted is 25,000, 11 lakh 25,000 warehousing charges, so total 11 lakh 50,000 and 75,000. So minus 11 lakh 50,000 and minus 75,000, which is depreciation. So 11 lakh 41,000 is the net profit from normal business. 11 lakh 41,500. Now friends, income from specified business, which will be part 2. Income, or you can say loss or income from specified business, which will be expenditure allowed as per section 35AD as production was commenced in the previous year, which is the current previous year, which is nothing but 20 lakhs, and what will be deducted is warehousing charges. This will be allowed as expenditure, and warehousing income, it was nothing but 11 lakh 25,000. So loss from specified business, it is nothing but 8 lakh 75,000. Let me recheck it. 20 lakh minus 11 lakh 25,000. 8 lakh 75,000. Fine. So friends, loss from specified business, this will be to be carried forward, because loss from, as we have discussed earlier, loss from specified business cannot be set off against the normal business. It can be set off only against profit of specified business as per section 73A. So no adjustment in the total income for this. Third is income from other sources, which will be, how much was the interest? 5,000 as per fourth adjustment. Yes, amount is 5,000, which will be added. And fourth is deduction. Deduction under section 80 GGB, which is electoral trust, payment to political party. This is 1 lakh, and the amount over here is not 10,000, 1 lakh we have already considered. What was the amount that was paid? Advertisement, yeah, that was advertisement published in a souvenir of a political party, and 2,500. So 2,500 friends will be deducted, allowed as deduction. So friends, total income, if you see, just to make sure we have included everything, after this only addition part will be left, that everything is fine, and what has been asked to us is compute the income chargeable to tax for assessment year 2021. So this is what we have already done, only the addition part is pending, and all the relevant adjustment has been considered. Advertisement, bonus, survey, income tax refund 5,000 is considered separately. Rent of premises, penalty beyond control 48.2. Electoral trust is also considered. Interest on loans is also considered. GST 3580 has been taken, and depreciation. So friends, we need to add this stuff. So total income chargeable for assessment year 2021 is nothing but what was the income from 11,41,500 normal business profit, 11,41,500 plus income from other sources minus 80 GGB deductions, which is 1,02,500. So 10,44,000 friends is the total income. 10,44,000. Now friends, continuing with the next illustration. Based on below information details, first of all, this illustration is related to section 33AB, wherein entity engaged in the business of growing, manufacturing tea in India. So such section 33AB is applicable to such SSC wherein amount deposited in a special account will be allowed as deduction in the year in which amount is deposited. Thereafter, the amount is supposed to be withdrawn for the purpose of the business of the SSC, for the purchasing of asset and so on and so forth. And there are also provisions wherein if you sell the asset subsequently, then what are the implications has been mentioned. Also, you will have to keep in mind that the business of growing and manufacturing tea would be an agricultural business, and accordingly part income only will be taxable. So the ratio applicable in the case of tea business is 60-40. 60% is agricultural income, 40% is the income which will be subject to tax. Based on this background, this illustration is based on section 33AB and taxability of the entity which is into manufacturing and growing of tea in India. Based on the below information details, you are required to determine the business income of CBDT Limited. So determine the business income of CBDT Limited and the tax consequences that may arise from the below transactions in the relevant assessment year. So tax consequences in the relevant assessment year, this word is important, wherein there are several assessment year involved in this problem. Accordingly, in each year, what will be the tax implications? We will have to solve it. CBDT Limited is engaged in the business of growing and manufacturing tea in India for the previous year ending 31st March 2019. So 31st March 2019, meaning the relevant previous year in this case is 1819. In that year, In the previous year 1819, its composite business profits before allowing deduction under section 33AB is 80 lakhs. So business profits for assessment year, we won't talk about the assessment year, we will speak about previous year. So previous year 1819, the business profits of the SSC were 80 lakhs and it was before allowing deduction under section 33AB. Accordingly, in order to determine the actual business income of CBDT Limited in the previous year 1819, we may have to deduct any deduction which is available under section 33AB. Since deduction has not been made as per the adjustment 2. On 15th of August 2019, which is relevant to the previous year 1920, it deposited a sum of 10 lakhs in the T development account. So an amount has been deposited in a special account in a T development account by the SSC and it is before the due date of filing return of income. So if I look from the perspective of financial year 1819, from the perspective of previous year 1819, then this amount is very much relevant for the purpose of deduction from the net profits. So third adjustment is ideally will be related to previous year 1819 and it will be adjusted against section 33AB against net profit of previous year 1819. During the previous year 1718, so the second previous year which has come into picture, CBDT Limited has incurred a business loss of 8 lakhs which has been carried forward. So there was a business loss of 8 lakhs. So even this adjustment, even this brought forward business loss can be adjusted first against the profit of previous year 1819. So second adjustment against the net profit has been stated in adjustment number 4. Fifth, on 14th of Feb 2020, it withdrew 10 lakhs. The deposit account which is utilized as under, so there was a withdrawal in Feb 2020, 1 lakh for purchase of machinery to be installed in office premises. It won't be allowed as deduction. It is not as prescribed by section 33AB. So it will be treated as income and it should be divided by in the ratio of 60-40. Only 40% of the income will be taxable. 8 lakhs for purchase of an asset as per specified scheme, as per the scheme specified. Fine, this will be allowed. And mind you, 8 lakhs won't be reflecting or there would be no deduction against the net profit as such of 8 lakhs only because the amount has been withdrawn. At the time of deposit into the T development account, SSC has already availed deduction of this amount of 8 lakhs. So again at the time of withdrawal for the purpose of this scheme, no further deduction will be available as per 33AB 6. These are as per the provisions of 33AB. 1 lakh was spent for the purpose of scheme on 5th of April 2020. So the amount has not been spent in the relevant previous year in this case. 1 lakh rupees has not been spent in the relevant previous year. Accordingly, the amount won't be eligible for the purpose of deduction under section 33AB. And this amount, since it has not been utilized in the current previous year in the previous year 1920, the same will be taxed as deemed profits and 40% of the amount will be taxable in the hands of CBDT Limited. what will be the consequence if the asset was purchased for 8 lakhs, which is this asset, is sold for 10 lakhs in May 2020. So the asset has been sold in the succeeding previous year itself. As per the provision of Section 33AB, an asset should not be sold within 8 years. If it has been sold within a period of 8 years, then any income out of it will be subject to tax as deemed profit up to the deduction considered, meaning up to 8 lakhs, the amount will be deemed profit as business income, and more than 8 lakhs, which is 10 lakhs minus 8 lakhs, in this case 2 lakhs will be taxable as capital gains because a capital asset has been transferred. So to the extent of deduction considered earlier, which is 8 lakhs, it will be a business profit, and anything excess of that will be capital gains. So friends, as you can see, three previous year are involved. First, previous year 18-19, for which a business profit of 80 lakhs has been suggested as per adjustment 2. To this, adjustment number 3 and 4 will be applicable, and in the fifth adjustment we are concerned with previous year 19-20, wherein amount which has been withdrawn, which amount will be not eligible, which amount has not been used for specified purposes, that amount will be deemed profit. And last one, this pointer is related to previous year 2021, wherein the asset has been sold. Then what are the consequences? Accordingly, the transactions in the relevant year, tax consequences in the relevant year are to be computed. This is what has been mentioned in the solution, in the question. Now friends, starting with the solution. So first, computation of business income. Computation of business income for previous year 18-19. Computation of business income of CBDT Limited for previous year 18-19. First is composite business profit, meaning it is before 60-40%. Composite business profit is nothing but 80 lakhs. Then amount deposited to the development account on 15th of August is 10 lakhs, in which should be deducted. Amount deposited will be allowed as deduction, and amount deposited will be lower of the following, which is nothing but amount deposited, amount to be allowed as deduction, you can say, amount to be allowed deduction under section 33AB, which is 1. 33AB1 will be lower of the following, which is nothing but amount deposited. Amount deposited, as we discussed earlier, amount deposited, since it is before filing of return of income, it will be considered part of the previous year 18-19. Accordingly, amount deposited allowed is 10 lakhs, and part B, it will be 40% of the business profits. Here friends, business profit is nothing but 80 lakhs. Out of that, only 40% is taxable, as 60-40 ratio will apply to a tea business. So 40% of 80 lakhs will be the business profits, and it is only a coincidence that 40% of the business profits over here and 60-40 ratio is applicable over here. So first you have to derive what is actually taxable, as business profits, which is 40% of 80 lakhs, and that will be business profit, right? So 80 lakhs into 40% is nothing but 32 lakhs. So you have to consider 32 lakhs, 40% of 32 lakhs, which is nothing but 12 lakh 8,000, 12 lakh 80,000, and lower of the two will be the amount allowed as deduction, right? So this will be deducted as amount deposited under section 33 AB1. Then the amount to be calculated will be, now friends, the next step is computing the net composite business profit after allowing deduction under section 33 AB. It is nothing but 80 lakhs minus 10 lakhs, which is 70 lakhs. Now this amount will be considered for 60-40 ratio. Now less 40% will be considered as business profits. So it is nothing but we have to consider 60% of 70 lakhs, right, of the above amount, which will be agricultural income, that should be deducted. 70 lakhs into 60% is nothing but 42 lakhs. 42 lakhs will be deducted from here. This is nothing but net business profit before deduction, before brought forward loss, which is of 8 lakhs. It should be 28 lakhs less brought forward loss, which will be 8 lakhs. Accordingly, taxable business income of CBDT Limited in previous year 18-19 is nothing but 20 lakhs. This is first part of the solution, wherein we had to ascertain business income for the previous year 18-19. Now friends, second part. So this was part 1. Part 2, let's go by previous year. Now for previous year 1920, just a second. Previous year 1920 is in the next page, wherein amount was withdrawn of 10 lakhs, right? And the breakup of 10 lakh is nothing but machinery used in office premises of 1 lakh, machinery used for the said purpose of 8 lakhs, and 1 lakh was not able to be used in the previous year 1920, right? So let's do the solution over here. You can continue over here. For simplicity purpose, we will not have to do to and fro from one page to another. So part 2 is continue over here, wherein we have to compute business income, computation of business income, for previous year 1920, wherein we will only address the withdrawal part, right? So the withdrawal part is machinery used in office premises. For that, the amount should be taxable as amount has not been used for the specified purpose, right? So as per section 33AB, the same will be subject to tax only because it hasn't been used for the specified purpose. 8 lakh for purchase of an asset as per specified scheme, as the same has been utilized for the purpose, then nothing will be considered as deemed profits. And as far as the deduction is considered, as we have discussed earlier also, the deduction was already allowed in the year of depositing the amount. So deduction is allowed under section 33AB when the amount is deposited, and when the amount is withdrawn, the withdrawal amount should be utilized for the purpose of the scheme, and that is what has been done for the purpose of 8 lakhs, the purchase of an asset, wherein the amount has been utilized for the benefit of, for the purpose of the scheme. Accordingly, that deduction won't be reversed in previous year 1920. So no adjustment for new machinery of 8 lakhs. New machinery used for specified purpose, deduction benefit availed in the year of deposit shall not be reversed, assuming that the asset purchase is a non-depreciable asset. Fine. I mean the specified scheme, the scheme provisions as per the scheme are satisfied. We have assumed that, and accordingly 8 lakh won't be reversed. So new machinery used for specified purposes, deduction benefit availed in the year of deposit shall not be reversed in previous year 1920. So here the amount will be nil. Next is 1 lakh was not spent, was spent in the next previous year. Amount unutilized. Withdrawal amount unutilized, utilized in previous year 1920. As we have discussed earlier, since the amount has been not utilized in the current previous year in the year of withdrawal, the same will be taxable in the hands of the SSC, which is 1 lakh. So effectively 2 lakh rupees is taxable in the hands of CBDT Limited in the previous year 1920. So total business income, you can say total composite business income is nothing but 2 lakhs, right? This needs to be bifurcated from agricultural income less 60% deemed to be agricultural income. It is nothing but 1 lakh 20,000, 60%, and accordingly net business income and business income of CBDT Limited in previous year will be 80,000. So this concludes part 2 as well, wherein machinery used for office is not eligible for deduction, is not eligible is since it is not used for specified purposes. Accordingly, it will be deemed profit in the hands of the company. Similarly, withdrawal amount, if not utilized in the year of withdrawal itself, then the amount will be deemed as profit in the year of withdrawal, even if subsequently it has been used in the subsequent previous year. And the same because the entity is into tea business, 60-40% ratio will be applied as per Rule 9. And third part is nothing but previous year 2021, in which the asset of 8 lakh which was purchased has been sold. And since the asset has been sold within 8 years, same will be subject to tax in the hands of the SSC in the year in which asset is transferred. Part 3, transfer of asset. Transfer of asset in previous year 2021. So this is the third assessment here, which is the last assessment here. In this, sale price of the asset is nothing but 10 lakhs less deduction allowed in section 33AB will be reversed, and it will be deemed to be profit. The same amount will be taxable as business profit. Let's mention it over here. Amount will be taxable in the year of transfer of asset, that is previous year 2021, as the asset has been transferred before expiry of 8 years. Fine. And this 8 lakhs will be subject to 60-40 ratio. So only 40% of 8 lakhs will be taxable as business income for previous year 2021. And this amount, capital gains of 2 lakhs. Right? This is capital gains and business income of CBDT Limited in previous year 2021 is nothing but 8 lakhs into 40%, which is nothing but 3,20,000 is the business income of the SSC in the previous year 2021. So friends, just a thought, whether the brought forward loss was exhausted in that previous year itself, in the previous year 18-19. Yes, so brought forward loss of 8 lakhs was exhausted in the previous year 18-19 only. Accordingly, it cannot be carried forward in previous year 19-20 and previous year 20-21. So friends, as you can see, there were 3 parts to the solution: previous year 18-19, 19-20, 20-21. In previous year 18-19, there was a business profit available, and also amount was deposited before the filing of return of income. Accordingly, the deposit amount in T development account was eligible for deduction in the previous year 18-19 itself, and the amount allowed was amount deposited or 40% of the business profits, whichever is lower, and thereafter we obtained 40-60 ratio as per Rule 9, as the entity is into T business. Then brought forward loss of previous year 17-18 was set off, and accordingly taxable business income of CBDT Limited in previous year 18-19 was 20 lakhs. Now, second part of the solution was related to previous year 1920, wherein amount withdrawn, whether any deemed profit is there or not, was to be ascertained, and accordingly machinery used for office premises and amount which was unutilized were deemed profits and accordingly taxable. Again, 40-60 ratio on the business income, composite business income was applied, and remaining 80,000 only, that is 40% of 2 lakhs, was taxable. And part 3 was related to transfer of asset, as the asset was transferred within 8 years before expiry of 8 years. Accordingly, that amount will be taxable as per section 33AB, and 8 lakhs was accordingly taxable. Obviously, that was subject to 60-40 ratio as per rule 9, and excess amount over the benefit taken, excess amount over 8 lakhs, 2 lakhs will be capital gains income taxable under section 45. So friends, this concludes this solution which was related to all the implications of section 33AB. Now friends, let's continue with the next illustration. Next illustration is, you're required to compute the taxable income. Ignore section 115BAA as well as MAT provisions are to be ignored of the Avengers Limited for the assessment year 2021 after considering the following information, duly explaining the reasons for each item of adjustment. So you need to compute the total taxable income of the SSC. Avengers Limited, a manufacturing company, has disclosed a net profit of 10 lakhs for the year ended 31st March 2020. So profit of 10 lakhs. A sum of 10,000 on account of liability foregone by a creditor has been taken to general reserve. So here you can see a trading liability, a benefit is arising to the SSC in the form of remission or cessation of a trading liability, and accordingly this will be taxable under section 41(1) as deemed profits even if the business is not in existence. However, in this case this won't be relevant. However, the amount of 10,000 will be taxable under section 41(1) as deemed profits. So friends, 10,000. The original purchases was debited to profit and loss account in the assessment year 15-16. That is fine. Being also engaged in the biotechnology business. Okay, so biotechnology business over here. The company incurred the following expenditure on in-house research and development as approved by the prescribed authority. So prescribed conditions have been fulfilled under section 35(2)(ab), and the nature of expenditure is research equipments purchased 2 lakhs and remuneration paid to scientist is 60,000. Both the expenditure will be allowed to the SSC at 150%, which is weighted reduction. For the previous year, the reduction is 150%. After previous year 1920, the weighted reduction will be reduced to 100%. But for your examination, November 19, this the relevant information is weighted deduction of 150 continues to be applied. So biotechnology business, in-house research and expenditure, research equipments purchased, and remuneration is 2,60,000, and this 2,60,000 has been debited to the profit and loss account already. However, we will require 150% of the expenditure, which is 2,60,000 into 150%. Advertisement expenditure debited to profit and loss account includes a sum of 50,000 paid in cash. So here the amount has been paid in cash, the expenditure has been incurred in cash, which is other than the prescribed modes as per section 40(a)(3). Accordingly, it will be straightforwardly disallowed if it doesn't fall in the exceptions of Rule 6(dd). The payment is to the sister concern for director, the market value of which is 40,000. So friends, the amount The transaction is not falling under Rule 6TD under the exceptions of Rule 6TD. So 50,000 will be straightforwardly disallowed, and the market value of which is 40,000 also, if it qualifies also, if the amount would have not been paid in cash, then applicability of 48 would apply, and only 40,000 would have been allowed, because any unreasonable expense, excessive expenditure to a specified person, to a relative of a director, will be disallowed as per section 48. Repairs of plant and machinery debited to profit and loss account includes, so here there is repair of plant and machinery which is available under section 31. Deduction is available under section 31 if it is a revenue expenditure. 2 lakhs towards replacement of worn out parts of machineries. So the repair is on account of replacement of worn out parts of machineries. Such expenditure does not increase the future benefit from the asset beyond its previously assessed standard of performance. So this para suggests that it is a revenue expenditure, and repairs are related to replacement of worn out parts of machineries. Here the replacement will depend on whether, the second para, which is this, it is already suggested that here it is an revenue expenditure, and accordingly same will be allowed under section 31. If it would have been a capital expenditure wherein they had mentioned, suppose that such expenditure increases the future benefit from the asset, in that scenario it would have been a capital expenditure wherein depreciation could have been claimed. Also, a reference to ICDS can be mentioned over here, ICDS 5, tangible fixed assets, wherein an amount is to be capitalized and amount will be part of actual cost only when it leads to increase in the future benefit from the asset beyond its previously assessed standard of performance. So these wordings are from nothing but are from ICDS 5, tangible fixed assets, where it has been specifically mentioned that any such expenditure which increases the future value of the which increases the future benefit of the asset, then it has to be capitalized. However, in our case, the repairs of plant and machinery debited will qualify for deduction under section 31, and accordingly, since the effect of 2 lakhs has already been given in the net profit, no adjustment is required in the solution. So by way of note, in the examination you can always mention the wordings that I have mentioned over here, and to remember at the time of solving the solution you can put a nil sign against this note, against this adjustment. And the last adjustment, friends, sale proceeds of input entitlements amounting to 1 lakh has been credited to profit and loss account, which the company claims as capital receipt not chargeable to income tax. So the sale proceeds of 1 lakh has already been credited to profit and loss account. However, as per company, as per SSC, they are contending that it is a capital receipt and ideally it should not be taxed. As per section 28(3)(a), import entitlements, sale of import entitlements, any proceeds therefrom will be subject to tax under section 28(3)(a). So it won't be a capital receipt, though nature appears to be a capital receipt. However, since it has been specifically mentioned under section 28(3)(a) to take it as revenue income, accordingly it will be taxable as business income under section 28. An effect for the same has already been given. So while computing profit and gains from business or profession, fifth adjustment will be nil, fourth adjustment will be nil, third adjustment will be straightforwardly disallowed. Second adjustment, 150% expenditure needs to be allowed. 100% has already been allowed, only 50% is left. And liability foregone, it will be an income under section 41(1). So friends, let's start the solution. Please prepare the format for profit and gains and start solving simultaneously with me. You can always pause the video and prepare the format. So friends, let's start with the solution. Computation of taxable income. Computation of taxable income of Avengers Limited for assessment year 2021. In here, net profit as per profit and loss account. It's nothing but how much is the amount? Net profit of 10 lakhs. Add expenses disallowed or income not considered. First is, let's go adjustment wise, or you can say it over here as well. Less, we can consider, let's consider it together. There are only 5 adjustments. So better to go adjustment wise and either add or less together. Less expenses not considered, income which are exempt, right? So first one, remission, benefit from remission or cessation of trading liability, taxable as deemed profit under section 41(1). So here amount taxable is 10,000, right? Then second adjustment is, and also the original purchases were debited to profit and loss account in assessment year 15-16. The year is not relevant. You have to just understand that the expenditure was considered in the previous year, and in the current year there is some sort of liability, there is some sort of benefit which has accrued to the SSC, and accordingly it has been subject to tax under section 41(1). Point number 2, biotechnology business in-house. You can say revenue expenditure on biotechnology business eligible for weighted deduction under section 35 2AB 1, eligible for weighted deduction under section 235 2AB at the rate of 150%. And here 260 lakhs has already been claimed, 2,60,000 has already been claimed. You have to consider additional expenditure. So 150% of expenditure incurred in the inner column, it will be 2,60,000 into 150%, right? Which is nothing but 3,90,000 less expenses claimed, which is 2,60,000, which needs to be deducted. So deduction allowed will be 1,30,000. So this was second adjustment. Third, and what is to be added? First pointer will be added to the net profit. Second pointer will be deducted, hence the minus sign. Third point, it's on the second page. Advertisement expenditure, there are two provisions involved. First is 40A2 and 40A3. If we go sequentially, 40A2 needs to be applied first, wherein excessive amount of 10,000 will be disallowed and 40,000 will be allowed as per 40A2. However, as per 40A3, nothing will be allowed to the SSC. So these both the provisions needs to be mentioned under the note section. So friends, third point is payment in cash to relative of a director, which will be disallowed as per excessive amount to be disallowed under section 40A 40A2, whereas the amount is in the inner column. The amount will be 40,000, which is nothing but this amount will be allowed, and the calculation part is nothing but 50,000 and minus 10,000, which is excessive. So ideally, you should be taking only 10,000. Yes, so 40,000 is the market value. So disallowed amount is 10,000, which you should be mentioning over here. This is a negative portion because 50,000 has already been considered in the books of income. So only 10,000 will be disallowed and 40,000 will be allowed. However, as per section 40A3, as the payment has been made, is made through other than prescribed mode and is exceeding 10,000. Accordingly, 40,000 will be disallowed. So ultimately 40,000, you can see entirely 50,000 is to be disallowed. 10,000 was by way of 40A2 and 40A3 has suggested that 40,000 should be disallowed. Total will be 40,000. Total will be 50,000. Accordingly, entire payment will be disallowed to the SSC. Fourth adjustment is related to repairs of plant and machinery. In that adjustment, friends, there was replacement of worn out parts of the plant and machinery. So first of all, we will have to analyze whether it's a revenue expenditure, capital expenditure, and through the subsequent para we understood that it is a revenue expenditure. And also we have to understand that whether replacement of worn out part will be termed as repair or not. For that, there is a High Court ruling. There is a ruling on this particular case wherein if replacement is in substance, if replacement of worn out part is in substance leading to replacement of only the particular worn out part, I mean it's not like overhauling the entire machinery, it should not result in coming into existence of the entire capital asset, but it should be only a portion of a capital asset, which is replacement of the worn out part only. If yes, then it will be considered as repair, and accordingly From the subsequent para, we came to know that it is a revenue expenditure. Accordingly, it can be concluded that the replacement, since it is a revenue expenditure, it will be repair of plant and machinery, and accordingly, deduction under section 31 is available to the SSC. So repairs of plant and machinery is allowed under section 31 as the same is revenue in nature. Also, we had made reference to ICDS 5 tangible fixed assets. It only stated that what is to be added to actual cost of the asset. If an asset is resulting in if the asset is resulting in future benefit to the existing asset, and the existing benefit, the exact wordings are in the adjustment. If these are the wordings which are coming from ICDS 5 tangible fixed asset, if it leads to increase in the future benefit from the asset beyond its previously assessed standard of performance, then in such a case it should be added to the actual cost, meaning it should be capitalized. And in our example, it can be proven that it is a revenue expenditure. So you can always give a reference, two additional references which I am not mentioning in the solution, two additional references, which is one of ICDS 5. I mean, how do you arrive to the conclusion that it is a revenue expenditure and not capital expenditure? First of all, the second para, which clearly states that future benefit are not so extending, and ICDS 5, which is related to tangible fixed assets, also suggests that only if it's a capital expenditure that it should be added to actual cost. Accordingly, we are adding the cost as a revenue expenditure under section 31. So these are additional references. Also, whether replacement of worn out plant and machinery can be termed as repair or not. There is a High Court ruling on this. I will mention the reference of the same over here, and through that it can be concluded that replacement of worn out plant and machinery is nothing but a repair, and it uses the wordings of this para only. It uses the wordings of this para only in the ruling. So friends, in the note section, there are two conclusions to be written. First is, how have you determined that it is a revenue expenditure? As the same is revenue in nature, it is because of ICDS. It is because there is no future benefit. There is no future benefit from the asset, or no enduring benefit from the asset. There is no future benefit from the asset, or no enduring benefit from the asset. Accordingly, it is not capital and expenditure. Then you may write references to ICDS 5 tangible fixed asset, and also it may be possible that you are not able to you are not able to quote the case law. Instead of getting it wrong, wherein you have to remember the entire citation, it's better that you mention the crux of the case law. Instead of mentioning the name of the case law, you can always write the crux of the case law, what it is trying to say, what has been held. That will be a better option. So let's choose to avoid let's choose to not mention the citation of the case law. Instead, we have mentioned the crux of the case law, which is nothing but no enduring benefit has been derived from the asset, as no enduring benefit is derived from the asset. Replacement cost can be termed to be in the nature of repairs, right? So both the reason remains the same in a way. Since there is no enduring benefit from the asset, replacement cost can be termed as repairs, and such repair cost can be termed as revenue in nature. And accordingly, the entire expenditure will be allowed, and here the amount will be nil. Fifth adjustment, and also if you want, you can mention in the notes this portion which is readily available to you, from which you can conclude that it is indeed a revenue expenditure. Also, sale proceeds of input entitlements of 1 lakh has already been credited. It is taxable under section 28(3)(a). You will have to mention a note therein, right? So, fifth point, and the last point, sale of import entitlement. Sale proceeds from import entitlements taxable under section 28(3)(a). Nil, because has already credited in the books of accounts, and the same reason will go to this portion as well, right friends? So this concludes all the adjustment, and total taxable income total taxable income of the company for assessment year 2021 is 10 lakh. First adjustment is to be added, so 10 lakh 10,000. Second adjustment reduction is available for biotechnology business, so 1 lakh 13,000. So 1 lakh 10,000, sorry, 10 lakh 10,000 minus 1 lakh 30,000, 8 lakh 80,000. Then 50,000 will be disallowed, again deduction, and fourth and fifth has no adjustment. So 8 lakh 80,000 minus 50,000 is nothing but 8 lakh 30,000. So 8 lakh 30,000 is the total taxable income of the Avengers Limited. So friends, this concludes the solution. Now friends, let's continue with the next illustration. This will be the second last illustration. Ironman is an association governed by the provisions of section 44A of the Income Tax Act. 44A is nothing but admissibility of deduction in the case of trade, professional or similar associations. So a special deduction is to be computed wherein if there is any deficiency in the course of activities of trade, professional or association, if there is any deficiency meaning income minus expenses are exceeding the income by way of subscriptions. In those cases, the deficiency therefrom can be adjusted against other income of the associations. However, there is a limit on the deficiency that can be adjusted. The deficiency can be adjusted up to 50% of the other income of the associations. The subscriptions received from members for the year ended 31st March 2020 was 2,50,000. The expenditure in the normal course of its activities are 4 lakhs. Its other income taxable under the Act works out to 2,50,000. So there is a deficiency of 2,50,000 minus 4 lakhs, which is 1,50,000. And can 1,50,000, this deficiency of 1,50,000, can it be adjusted against 2,50,000? Needs to be ascertained. You are consulted as to how Ironman's income would be determined for assessment year 2021. On your screen, the solution. So friends, section 44A is related to special deduction admissible to trade associations, professional associations, wherein there is a deficiency, wherein there is a loss from the normal course of activities. So we have to computation of total income of Ironman for assessment year 2021. First of all, obviously, particulars in the format you have to write this, an amount, right? Then income from subscriptions received from members, right? This is nothing but 2,50,000 less expenditure in the normal course of business, which is 4 lakhs. Accordingly, there is a deficiency which is nothing but 1,50,000. So while computing the total income of the association, okay, the format is not proper. Okay, fine. So now we have to compute other taxable income. Other taxable income is nothing but 2,50,000 and less deduction under section 44A will be nothing but amount of deficiency, which is 1,50,000, or 50% of other taxable income. The taxable income, which is nothing but 2,50,000 into 50%, which is 1,25,000, whichever is lower. So 1,25,000 only will be allowed as deduction. So taxable income, and this computation is as per 44A 3 clause 3. Taxable income of Ironman is nothing but 1,25,000. So you can always mention here taxable income of Ironman Association for assessment year 2021 is nothing but 1,25,000. So basically the crux of the problem was how to compute deduction under section 44A where there is a deficiency, and how it can be diverted to total taxable income, how it is supposed to be calculated while computing the overall income of the association, and in this case it is 1,25,000. So friends, let's start with the last illustration for the topic profit and gains from business or profession. On your screen Voda obtained a telecom license on 1st of April 2017 for a period of 10 years ending on 31st of March 2027. So the license has been obtained in 1/4/2017 and the current previous year is 1920. So it was acquired previously, it was acquired 2 years previously against a fee of 30 lakhs to be paid in 3 installments. So 30 lakh amount is to be paid in 3 installments of 10 lakh each by April 17, April 18 and April 19 respectively. So the payment for acquisition of telecom license total fees is 30 lakhs and telecom operator is allowed to pay the same in 3 installments which is 10 lakhs each from April 17 to April 19. Here we have to compute the amount of deduction that will be eligible under section 35 ABB. The company has commenced business on 31st of May 2018. This line is important because for computing deduction under section 35 ABB, deduction will start from the year in which commencement of business has been made. So in the previous year 1819, the business has commenced and accordingly deduction eligibility for the SSC will be from 1819. So any payment made in April 17, which was the first installment, will be expenditure prior to the commencement of business. It will be allowed, it would have been allowed in 1819 previous year. Also expenditure installment which has been paid in 1819 would have been allowed in 1819. So for previous year 1920, we will see that deduction of all the 3 installments will be available in bits and pieces that we will compute. Explain how the payment made for license fee shall be dealt with under the Income Tax Act and the amount, if any, deductible for assessment year 2021, and the relevant section for this is 35 to ABB. 35 ABB. So friends, on your screen, better to draw a format before starting the solution. Now we have to compute the deduction for assessment year. Computation of deduction under section 35 ABB for assessment year 2020-2021 in the hands of. It's always better when you start the solution, you write this header wherein what is expected you mention it, computation of total income or computation of deduction allowable under so and so section, assessment year, mention it, and in the hands of SSC, the name of the SSC should be mentioned. So mention the assessment year, mention the name of the SSC, and thereafter start the solution. Again, particulars and amount. Here the format would be a bit different from the normal format that we do. Here, let's go assessment year wise. What's the deduction available from AY previous year 17-18? So here particulars will be, you can say, previous year, right? Then you should be mentioning over here unexpired period, unexpired period, and installment amount, and what is the deduction amount. Installment and deduction, right? 4 columns. So previous year 17-18, it would be an expired period is, you will have to count from 18-19, from the period from which the business has commenced, which is 18-19, right? So the deduction will be counted from first year is 18-19 and 19-20 previous year is the second year. So the unexpired period will be counted from 18-19, and accordingly 9 years is the unexpired period, wherein the installment is nothing but 30 lakhs divided by 3, 10 lakhs, and accordingly the deduction amount will be 10 divided by 9. You can mention it over here as 1.11 lakhs. Correct? 2018-19 previous year, similar situation. 9 years are pending. 17-18 and 18-19 will be synonymous. Installment is nothing but 10 lakhs, and it will have the same answer. 2019-20 unexpired period is, this is the first year, accordingly 10 years. Installment amount remains the same, 10 lakhs, and accordingly 1 lakh is the amount. Accordingly, total deduction under section 35 ABB is nothing but 3.22 lakhs. So friends, it's a bit confusing. I mean, you will have to practice how to compute year on year the deduction available. The amount of 10 lakhs is distributed evenly among the 10 years, right? And it should be divided by the unexpired period. Here is where the complication starts, where it has to be divided by number of years. So friends, here you can see the unexpired period. The format has been distorted over here. Never mind. Unexpired period, you can see, is 9 years, 9 years, and 19-20 ideally should be 8 years. The unexpired period will only decrease year on year. It will never exceed. Fine. So the amount over here is, previous year 17-18 and 18-19 is fine, which will be divided by the unexpired period. The amount of installment is to be divided by unexpired period. For 17-18, it was 9 years. If the business had commenced in 17-18, then the unexpired period for the first year would have been 10. Then second, which is in 18-19, it is 9. And since the commercial production has started, the business has commenced only in 18-19, we have started computing from that year the unexpiry period. So 18-19 up till 26-27 previous year 26, 20-26, 27, from the unexpiry period up till 27th year is 9 years, and it should be in the decreasing trend only henceforth. Accordingly, 8 years should be the answer, and here the amount should be altered, which will be 10 divided by 8. 1.25 should be the answer, right guys? 1.25 lakhs and plus 1.11 plus 1.11, which is 347 lakhs. The answer should be 347 lakhs. So friends, total deduction under section 35 ABB is nothing but 3.47 lakhs for the assessment year 2021. So friends, this concludes the illustration part of the topic profit and gains from the business or profession. Thank you.